Finance Live. I'm Brad Smith alongside Shauna Smith. We've got some breaking inflation data out this morning. June CPI crossing.
All right, Brad, I'm looking at these numbers right now. You've got the CPI print on a month-over-month basis actually declining by 0.1%, so better than expected there. You're looking at the core month-over-month figure coming in with a rise of 0.1%, which was slightly below what the street was looking for, so a further improvement there. Also a further improvement on the prior reading. When you take a look at that headline number, CPI year-over-year coming in at 3% flat, that was better than the street had been forecasting. Also an improvement from the 3.3% reading the prior month. When it comes to that core CPI print at year-over-year number, that's coming in at 3.3%, which was also better than expected for the street of 3.4%. So again, we're looking at this reaction instantly here in the futures market. Not a huge move to the upside, maybe because a lot of this had already been priced in at this point. But again, this report here pointing to further progress in the Fed's fight to tame inflation here. And as a result, we're seeing some movement here in the futures market, although not a huge move at all.
Yeah, I'm taking a look at some of the indexes which increased in June. Shelter, motor vehicle insurance, household furnishing and operations, medical care, and personal care. All this considered, it looks like the decline and especially the index for gasoline falling 3.8% in June after declining 3.6% in May, more than offsetting the increase in shelter here. The energy index falling 2% over the month as it did the preceding month, and the index for food increased by about 0.2% in June. Some of the areas, though, where the indexes fell, and quite dramatically here, we're ultimately looking at the indexes for airline fares, used cars and trucks, and then communication, among those that did decrease over the month here. And so that kind of getting us to this decline that we saw by 0.1% month over month, at least, with all items included there.
Yeah, exactly. And I think going into this print, especially following on the heels of some of the latest commentary that we've gotten from Fed Chair Jay Powell, pointing to the fact that he was confident in the fact that the inflation picture had been improving here over the last several months, confident in the fact that that would continue here in the coming months. So again, this print coming in better than expected, really showing that the disinflationary path is intact, and we're seeing a bit of a reaction here in the markets this morning.
Yeah, absolutely. We're taking a look at the futures, and ultimately, let's get to a little bit more of that market reaction here. We've got Yahoo Finance's very own Jared Blickery standing by for a check on how the markets are reacting here. A little bit of a deeper dive. Hey, Jared.
Yes, with one of the figures flashing outright deflation, at least on a month-to-month basis, we have futures rallying now. You can see Dow futures up about 84 points or 0.2%. We can check out the NASDAQ, which is just a bit higher, and I'll show you a price chart of the overnight action. These are the NASDAQ 100 futures. They were in the red just slightly before the announcements and now solidly in the green. 0.33%, not an incredibly big move, but I'm seeing an outsized move in the 10-year T-note futures. So this is where we see when the prices are up here, that means the yields are going down. So definitely pricing in the potential for some rate cuts here by the Fed. And if you take a look at gold futures, I think this is really emblematic of where we are right now. This is a risk-on movement for gold, yet we are seeing outright contraction in some of these CPI numbers. Why is that? Because now markets are pricing in a more accommodative Fed, which, well, that gooses gold prices. So there you go. That's the logic there. 2404 is a print on gold right now. And I'll show you copper. I don't necessarily expect copper to react in a big way to this report, but nevertheless, you got a small bump to the upside. Before I check out the sector action, do want to hit Bitcoin. Not seeing a lot of movement there. Already in the green over the last 24 hours, as you can see. And then rounding out the price action in the sectors, we can see real estate is up 1.33% in the pre-market. It was up 0.7%. Yesterday, that's that background number. Utilities also strong. That's a very interest rate sensitive sector, so not surprising to see that going in the right direction, considering the drop in yields that we saw. XLK, that's the tech ETF. That's up 0.5%. So pretty bullish reaction around the horn here.
All right, Jared, thanks so much. We're going to continue this conversation around the June CPI report. We've got Peter Chur, who is the Academy Securities Head of MicroStrategy, here in studio with us. Peter, I'm looking to my left here. I see you've got your iPad out. You've got your tables loaded up here. So you've clearly been diving into this report over the last few minutes here as we're seeing some market reaction. I want to get your read in.
One, I think it's a great number. I think it puts September firmly on pace now for a cut, and maybe even starts getting some conversation about end of July. We might need some more data. I think you hit on one really important thing, that shelter was still contributing to inflation, but it was only 0.2 this month. It's been very stubborn at 0.4, and it's one of those indicators that's known to lag. The way it's calculated has old data in. It hasn't been keeping up with anything contemporaneous, right? If you look at a Zillow or any sort of report about rent, it's been coming down faster. This is encouraging, so I think it's a good sign for the coming months. I think it's a really good report, and some of the reports we've had in the past few months, you look at the details and they're a bit sketchy. This looks pretty solid all the way around, at least on the first glance.
Peter, we have the market's reaction up right now. When we take a look at futures, yes, we are seeing this move to the upside. They have been under just a bit of pressure here ahead of this print. What does this tell us, though? It's a bit of a muted reaction, I think you could characterize this, just in regards to when you compare it to the print that we got. What does that tell us then about future upside? Do those gains maybe look like maybe they're not so significant?
Yeah, and it's interesting because I'm looking at the bond market. I think the 10 years down 10 basis points. So you had a pretty significant reaction in the bond market. The front end's even moving more. I think the equity markets got ahead of themselves. Like the last few days coming into the close, we've done very well. So I think equities are already priced in for this. Maybe the bond market, maybe we're a little bit more stubborn and wanted to see the data. So I think that's a sign that, yeah, it's going to be hard for a lot more gains. I think this puts the Fed, story intact. Now we get back to, can AI keep driving this entire market? Because until the last couple of days, it's really been so much AI stocks. It's been encouraging the last few days where you've seen the Russell 2000, the equal weighted kind of come along. And that's something I think a lot of us are looking for.
Do you think it can? Sorry.
Yeah.
Unfortunately, I still more in the view that we'll get a slight downturn in equities, even with the good Fed, and you'll get the catch up mostly because the momentum stocks will lead the way lower a little bit. It's not going to be a dramatic pullback, but that's how I see it right now. But I think it is time to start adding value, equal weighted indices to your portfolio.
I'm taking a look at some of the CME Fed Watch probability that's kind of moving around here after this report just came through. And it doesn't seem like there's too much of an outsized reaction, even for the meetings that you were pointing to a moment ago. A lot of the markets have been focused in, zeroing in on September as that first cut, and then looking out to December for a potential second cut here. But can the markets continue to see all-time highs on AI fervor alone, plus a lack of cuts potentially?
I don't think so. I think, that I would have expected 2 or 3 months ago for the small caps, for the value stocks to catch up, right? Because we were getting, okay, the Fed's going to be good, and we had decent economic data, and they couldn't rally. And right now, I'm a little bit concerned. The job market's rolling over. We're seeing some weakness there. The last report, the headline was great, but a lot of it was public sector. And I'm very concerned some of the seasonal adjustments have been missing and overstated jobs in January and February, and we're going to pay for that in the July and August numbers where the seasonal adjustments will actually understate jobs.
So that's an interesting point. If we don't see the Fed act soon, I guess how much further weakness do you think we could potentially see within the jobs market?
I think significant. When you look around anecdotally, right? Even last summer, we called last summer at Academy the summer of travel or the summer of vacation. Everyone was hell bent on taking their 2 weeks. They were doing this. It's still popular, but it feels like we're more normalized. And you look at, hotels. You can find hotels a week in advance. All these things are pointing to what we were calling. We had 2 COVID bumps, very distinct in terms of inflation and jobs. The one was goods. It was very fast. Yeah. What we saw in services was a much slower buildup and a slower decline, but we're starting to see that. So I think jobs are pulling back, spending's pulling back. Everyone's going to be a little bit cautious ahead of this election. We don't even yet know officially, I guess, who's going to be running in the election, let alone what policies are going to be on the table. So I think that's going to slow investment and capital investment, maybe away from anything other than AI, but even AI. Will people continue to put money into it right now? And if the stock market starts rolling over, it's been so momentum driven that I could see that falling off a little bit quickly. And I think you've talked about this a fair bit in the past too, but the S&P 500, 10 stocks are about 40%. So every dollar that goes into SPY, every dollar that goes into QQQ gets disproportionately put into those same stocks, and that's been helpful. Unfortunately, if we start seeing any profit taking, I think it can turn just as quickly.
Yeah, it's really interesting in what you were mentioning. I mean, we went from last summer and the summer of the women-led economy to now the summer that's really just focused around 2 old dudes as of right now, and trying to figure out what's going to take place there. 3 if you include Fed Chair Jay Powell. No offense to him, very seasoned, very smart. But at the end of the day, you've got to think about where in the employment situation that's actually casting doubt on spending ability for a lot of consumers out there. Are you seeing significant cracks, and if so, where?
I think you see some cracks at the lower end of the consumer. You're seeing some little uptick in credit card delinquencies, little uptick in parts of the autos. Nothing to be alarmed at. And again, it's really hard to judge this because we had that COVID bump and all of a sudden everyone was debt-free. Everyone had more cash than they knew what to do with. And so some of the data has been tricky to analyze and compare. I keep trying to go back to what it looked like in 2018. And I think the labor market's slightly worse than 2018. I think the low end of the consumer is starting to bottom a little bit, to turn over a little bit. And that's where our fears are.
All right, Peter Chair, always great to have you, especially on a day like today. Thanks so much for joining us here in studio to break down this report.
Thanks for having me.
All right, let's do a quick recap of the latest inflation data that we just got out minutes ago. Coming in better than expected, a pretty softer print, I think you can characterize this. CPI month over month coming in at a decline of 0.1%. That was better than expected. The headline number coming in at 3% growth. That was also an improvement from the prior reading and coming in slightly below the street's expectations. The same can be said for those core numbers. The core month over month coming in at a growth of 0.1% on a year-over-year basis. Core CPI up just about 3.3%, which was also better than expected. You're seeing the reaction play out in the equities market. You're looking at gains across the board. If we flip it over to the bond market, that's really where we are seeing a bulk of the reaction there. We're seeing a massive decline in yields in real time. We are seeing pressure on those yields here, pulling it to the downside. Also, gold on the flip side, catching a bit to the upside as it does benefit here. One of the major beneficiaries of this slightly soft U.S. inflation data print that we got out here this morning. All right, keep it right here on Yahoo Finance. We got much more coming up. We'll be right back. You have futures moving to the upside this morning after June's inflation print coming in better than expected. Let's take a deep dive into three sectors that have been hit historically by that sticky inflation prints. We've got shelter, energy, and healthcare. Here with team coverage to break it all down, Yahoo Finance's Madison Mills, Jared Blickry, and Anjali Kamlani standing by. Maddie, let's start with you here. You're watching shelter inflation, which has been one of the biggest contributors to inflation this year. No surprise there. What are we seeing this month?
Housing inflation finally starting to cooperate with what the Federal Reserve is wanting to see. And this is a key driver of that overall headline coolness that we were able to see in today's CPI print. I just want to run through a couple of the numbers. So you are at 5.2% year on year. That makes shelter the second biggest contributing factor to year on year inflation, coming in just below expectations. But month over month, you're looking at 0.2%, and the owner's equivalent rent coming in at the lowest levels since August of 2021. Now, another interesting stat I want to pull out here is the lodging away from home index. That decreased 2% in June, which is a little bit odd given that we are in the peak of summer travel season. That could be either a survey issue, given that that decline is so severe there, or it could be indicative of a real consumer slowdown when it comes to demand for travel, which could be a really interesting parlay into what we might be able to see come this earnings cycle and some of those travel related names. Having said that, the broader takeaway from the shelter numbers that we got in this morning is that this really sticky area for inflation, we're starting to see some progress there, but what does that mean for rate cuts moving forward is still, of course, the key question. Jared, I know that you are also taking a look at what is going on in terms of the CPI numbers this morning. What do you have for us?
That's right. I'm looking at energy, and a big reason why that headline number ticked negative for the month of June has to do with the energy component. So energy for all commodities down, actually just energy is down 0.2%. But when you take a look at the year over year numbers, you can see it's actually positive. So still up 1% year over year. But then when you break it down by different types, you take a look at gasoline, for instance, that's down 3.8% month over month, and it's down 2.5% year over year. So both of those numbers going in the right direction. And then if you take a look at energy services, this would be, for instance, the electricity in your home or piped gas service. When you take a look at energy services, that's down negative 0.1%. So basically 10 basis points for the month of June. But it's still elevated year over year, still up 4.3%. So it looks like energy prices kind of coming down. These are very volatile, but I would say that it's a very important component of what Powell is looking at, and also gives a lot of evidence for the Fed to raise or to lower those rates finally in September, possibly July. So I know, Anjali, you're watching healthcare.
That's right, Jared. Now, surprisingly, the growth for healthcare has actually slowed over time, but unsurprisingly, you still see it grow month over month as well as year over year. If you take a look at the numbers for June, we saw a 0.2% growth month over month and then 3.3% year over year. That compares to 3.1 in May. So as you can see, still that slight growth that you're seeing and a little bit slower growth compared to what we saw in May. Now, meanwhile, I also want to take a look at what the specific breakouts are. We know that, for example, physician services as well as hospital grew 0.1%. Meanwhile, the index for prescription drugs, that is unchanged, and that is coming at a time where we know that there's a lot of emphasis on prescription drugs and the cost to the overall healthcare system. We also know behind the scenes that there is expected inflation from the increased salaries of physicians and healthcare clinicians in the coming months, as we've seen that also take a track with the jobs report. So something that I want to point out, we've also seen a little bit of a slower growth since 2021. That was really the turning point, and that trend continues. Prior to that, we know that healthcare outpaced the index and outpaced other sectors when it came to growth, but we're still seeing a little bit of contraction still with the growth in those areas. So that's where healthcare stands right now. Back to you guys.
All right, Anj, Jared, Madison, Maddie, thanks so much. Appreciate it. Well, futures, as we've been continuing to track them this morning, they are higher after that June CPI data came in cooler than expected, declining actually 0.1% month over month. A rise of 0.1% was expected. Joining us now, we've got Tom Porcelli, who is the chief U.S. economist at PGIM Fixed Income, and Greg Dacko, who is the EY chief economist. Great to have you both here with us. Just want to get your read in. I mean, we were expecting a fractional gain on the all items essentially, but we got a fractional decline here. And so, I mean, are we on the train to deflation, or is it too early to declare victory at this juncture? Tom, I'll go to you first.
Yeah, so good to be with you all. Yeah, look, I think that we are on the train to the Fed teeing up a cut. Look, I think we were on that train before this number, but I think this number gives the Fed quite a bit of comfort. If you look at sort of some of the components, I get it, right? In so many ways, the shelter component is putting a floor underneath in inflation at large. And it behaved very sort of nicely this month. I would hasten to add, though, the thing that the Fed, one of the key reasons why the Fed even created the super core measure was to basically, in part, to remove the shelter component, because I think everyone sort of appreciates that it's just, there's some calculation issues there. So if you just look at headline CPI and you look at core CPI and you strip out shelter from both of those, you're now under 2%. You're running at a 1.8% pace. So I think the inflation fear that had been out there for so long, I think that the Fed is now, I think, moving beyond that, and I think the Fed is now really focused more on labor, which I would argue that they've actually been more focused on that for months. But I think Powell is now really sort of driving that home more out in the open. So I think with labor starting the process of slowing down, I think it's very reasonable to expect that the Fed will start the process of removing some of those hikes that they put in place.
Greg, do you think July's on the table?
July is on the table. I think it should have been on the table. I think June should have been on the table as well as an optimal time to recalibrate monetary policy. I think there's been way too much attention being given to this first rate cut. What we're talking about is really recalibrating monetary policy to today's circumstances and tomorrow's outlook. I think Powell was clear in his testimony to Congress, saying that inflation is no longer the main risk and the only risk that we face. We are in an environment where you and I have discussed this in the past, where inflation has been cooling. The underlying drivers of disinflation remain firmly in place. We have slower consumer spending. We have weakening labor markets. We have an environment where pricing power has diminished and where pricing sensitivity has increased. These are all disinflationary. So these types of reports that we just saw this morning, where inflation continues to ease, is exactly the type of report that the Fed is looking for as we continue to move closer to the Fed's 2% target. I think now is really the time to reconsider whether we need as restrictive monetary policy as we've had for the past year, or whether it's time to gradually recalibrate and avoid exerting too much pain on the economy at this delicate juncture.
I mean, this delicate juncture as well, just to follow up on that, Greg, is really because we have a general election as well in November that places them in the scenario of, okay, if we're going to seem apolitical, do we have to get out ahead of that with enough time to be able to cut, or wait until the dust is settled and then initiate that first cut? I mean, what is the calculus you imagine that the Fed is navigating through, especially as they do run the risk of remaining too tight for too long because of that central event that the political sphere is paying close attention to in the markets to a certain extent?
Definitely an optics element to the Fed's decision when it comes to the elections, but I think the Fed is really keenly focused on ensuring that inflation moves down in a sustainable manner towards its 2% target. There are a few policymakers that are still leaning towards the hawkish side, are not likely to be in favor of any imminent rate cut. But I think gradually we're going to see Fed Chair Powell lead a core of Fed policymakers towards adopting a softer monetary policy stance, a less restrictive monetary policy stance, and recalibrate. The numbers in this report were very interesting because we have one of the key elements that has been supporting inflation, as Tom was saying earlier, which has been shelter cost inflation, which is now moderating quite significantly. And at the same time, you're seeing pockets of softness on the services sector side. Hotel prices falling 2.5%, airfares falling 5%. These are signs of consumers exercising more prudence and businesses having to adjust their pricing in this more prudent consumer spending environment. I think the Fed should take note of this increased consumer prudence and recalibrate monetary policy, again, to today's economic realities.
Tom, when you take a look at the bond market's reaction here, you've got the 10-year yield right around that 4.2 level. You're also seeing a significant drop here in some of those shorter duration yields. Is that validated, do you think, by this print? And what does that signal then, do you think, for some of the action we could see in the coming weeks?
Yeah, one of the things that we've been trying to drive home is that the market has really been in sort of price discovery mode, right? Really trying to understand, what was going to happen from a sort of a policy reaction perspective. And I think, data like today, I think really sort of validate the idea that the market has been right to sort of price in a September cut over the last few weeks in particular. So, right now, if I look at, sort of what the pricing is for September, it's close to 90% priced in for a cut. And I think given a data point like this, I think that's quite right. And I think Greg makes such a really important point. I think if you consider sort of, we're all always focused on sort of calendar years. What's the Fed going to do this year? But I think more compelling is what's the Fed going to do over the course of this cycle? And I can easily make an argument that between now and, sort of to say the end of next year, that you're easily looking at 150 basis points worth of cuts. And by the way, that's again just an arbitrary sort of endpoint. I mean, I think by the time all is said and done, I think that you could easily be somewhere between sort of 3 and 3.5% from a Fed funds perspective. And again, I think given the backdrop, given the slowing that we've seen in inflation, given the slowing that we're seeing in labor, I think it's right for the Fed to make this a journey toward at least getting to neutral. And I think that's over the course of the next year and a half. I think that's probably the right way of thinking about this Fed.
All right, Tom Porcelli, always great to talk to you, Chief U.S. Economist at PGIM Fixed Income, and Greg Dacco, EY's Chief Economist. Thanks to you both for making the time to join us here this morning. Let's do a quick check of the markets. We're just about 35 minutes ahead of the opening bell on Wall Street. We're seeing a bit of a reversal here with the equity markets. You've got now the futures for the Dow, the S&P, and the NASDAQ all pointing to the downside. Maybe much of this good news of the print had already been priced into the equity markets. That's what we heard from Peter Chur earlier in the hour. Flipping it over to the yield reaction, because that's really where we are seeing the bulk of the reaction to this print in the bond market. Yields pulling back. You've got the 10-year right around that 4.2 level. You're also seeing some pressure here for the 5-year and the 30-year, as well as the 2-year. So again, a softer than expected print for inflation, showing further progress, what the Fed has been set out to do now for several months in a row, and also just validating some of the commentary that we've gotten from Fed Chair Jay Powell over the last several weeks, and as recent as this week during his testimony on Capitol Hill, saying that he is confident in that disinflationary path. So again, CPI print coming in just lower than expected across all 4 metrics, and we're seeing that reaction play out, especially in the bond market here this morning. Keep right here on Yahoo Finance. We got much more on the other side of the break. It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief.
Stock futures are lower this morning, even as June's CPI report shows inflation cooling further, bolstering hope across Wall Street that the Fed will cut rates sooner rather than later. Treasury yields, though, we're keeping close tabs on them, diving on the latest data here. Let's get to it with the three things that you need to know this Thursday morning. Yahoo Finance's Jared Blickery, Madison Mills, and Inez Ferre have more.
Stock futures falling even after June's CPI report shows further signs of inflation moderating. Headline inflation month over month actually falling 0.1%, beating the street's expectation for a 0.1% rise. Now, annually, price growth cooled slightly, up 3%, below expectations. And core CPI, which excludes volatile food and energy prices, also moderating both month over month and annually. Overall, an encouraging report for investors who are eager to see the Fed cut rates sooner rather than later.
And shares of Delta Airlines plunging this morning as discounted airfares put pressure on earnings. Delta missing on profit expectations for the third quarter, and profits for the second quarter also coming in below estimates. Delta CEO Ed Bastian told Yahoo Finance that summer travel demand does remain healthy despite these numbers, but he did acknowledge that some consumer challenges are here. Take a listen.
The domestic marketplace is where a little bit of the price sensitivity is starting to take hold, and it's in the lower fare buckets.
PepsiCo trading to the downside this morning after posting weaker than expected sales amid declining demand for drinks and snacks as inflation weighs on shoppers. The snack maker's revenue came in at $22.5 billion, just shy of estimates. The company citing subdued performance in North America as well as effects of product recalls at Quaker Foods. Specifically, Quaker Foods volume declined a whopping 17%. Overall, volume declined 2% for food. PepsiCo now expects to deliver 4% organic revenue growth for the full year. That was previously at least 4%.
We've got a fresh read on inflation. June's inflation print coming in cooler than expected this morning, and sent futures higher initially, but now they reverse course a little bit here, and we're seeing fractional declines, flat just barely to the downside across all of the U.S. major averages as of right now, Shauna.
Yeah, Brad, we are seeing a bit of a reversal here. I think a lot of this good news in terms of inflation, some of that improvement has really already been priced into the market, so that now being reflected, something that we heard from Peter Schur last hour. I also want to pull up gold because that's moving to the upside, a clear beneficiary here on that improvement in inflation. You're seeing across above 2,400 an ounce. And when you take a look at the yield market, when you take a look at some of the pricing that we're seeing there, at least when it comes to the Treasury yields, we're seeing them move lower in yields and move higher in prices. They move inversely here to each other. That's not necessarily a huge surprise there. And we're really seeing that downward movement almost across the curve. So a bit of a steepening there, especially when you take a look at the downward movement in the 5-year and the 2-year then. So again, investors really pricing in the options, the hope, the odds that we are going to get a Fed rate cut sooner rather than later. We heard from a number of guests here this morning saying that September obviously still on the table, but now there's even more and more talk about the possibility of July. So let's talk a little bit more about that. For that, we want to bring in Mark Zandi. He's Moody's Analytics chief economist here. Mark, it's great to see you. So talk to me just about your reaction to this print and ultimately what it signals, do you think, for the Fed?
Great news, Shauna. It was pretty close to script, even a little bit better than script. It shows that inflation is moderating steadily, coming back into the Federal Reserve's target. My favorite measure of inflation, and the measure that I think gets to underlying inflation, is the so-called harmonized CPI that excludes the implicit cost of home ownership, which is really tough to measure, and the rest of the world doesn't even try. And that's back to the Fed's target and has been for a better part of the past year. So, we're if we're not at target by any measure, it's in clear view. It's dead ahead, and all the trend lines look pretty good. So, given that, I think the Fed should start cutting interest rates. That probably won't happen until September. They want a couple more months of really good inflation numbers, but I think they'll get them, and we'll get a September rate cut.
What type of effect then do you anticipate that's going to have on the housing market? Because that's where we might be looking for some spur in demand if there is. cut that finally gets announced, that finally gets put into effect, and for potential home buyers that have been sitting on the sidelines waiting, or even for those who are looking for even more cuts to refinance, that's anticipated to have even more of effect on that marker that you mentioned that the Fed is going to be keeping close tabs on shelter.
Well, Brad, I think the most immediate benefit is to lower income households through lower payments on things like credit cards or consumer finance loans, buy now, pay later. Might see auto loan rates come in, and that would be very helpful for, again, lower middle income households who are been unable to purchase a car because of the cost of financing. So I think that's where we see the biggest benefit. It should help the housing market. My sense is we will see, if the Fed starts cutting rates, that'll help the yield curve become more normally shaped, and the volatility in the bond market should moderate. And that means mortgage rates, the 30-year fixed mortgage rate should start to come in and be more consistent with the 10-year Treasury yield. So that will ultimately help housing demand. I mean, right now the 30-year fix is at 7%, and anything over 7, the housing market it feels like it goes into a deep freeze. People just can't afford to buy a home. Closer to 6, things come back to life. So I think the Fed's move, and if they can signal that they're going to continue to cut interest rates, I think we'll get rates from going from 7 closer to 6, and that's when life starts to come back in the housing market.
Mark, my question to you is, there's been more and more focus on some of the weakening that's happening within the labor market right now. Even Chair Powell commented on that down the Hill this week. If we don't see a September rate cut, how much further weakness do you think we could potentially see in the labor market then in the coming months?
Yeah, I think that would be a mistake. I mean, I think the economy is under a lot of strain from the higher rates. It's doing some damage. The labor market is the most obvious place. I mean, hours worked are down, temp jobs are down, hiring rates, quit rates are down. The job growth is slowing. All the revisions we're getting now are to the downside. They're reducing estimated job growth. So unemployment insurance claims are up. That might be more seasonal than anything. We'll have to see. But it does feel like businesses are starting to lay off a bit more. So yeah, I worry about that if the Fed keeps rates here too high for too long. And of course, the other kind of stress point is the financial system, the banking system, and the broader financial system, because the yield curve is inverted. Short-term interest rates are higher than long-term rates, and that is a very uncomfortable place for folks in the financial system trying to make some money on their net interest margins. And so I worry that we could see some other type of event in the financial system. So I think it's really important that the Fed follows through here and starts cutting rates.
Mark, what does that type of event potentially look like? And talk to us a little bit more about what maybe some of those stressors could trigger when we talk about that wider fallout.
Well, there's a few. I'll call out one. The bond market, it feels really choppy. The liquidity in the market is very poor. And that goes to a number of things. Most significantly, the broker dealers, the divisions of big banks that do the trading in the bond market, they haven't increased the size of their business, their balance sheet, to be consistent with the growth in the amount of debt outstanding. We've had all this treasury debt, that's been because of the large budget deficits, and the broker dealers have not kept up. That goes to capital rules, and it's not economic for the banks to invest in these broker dealers. And that's adding to the problems of liquidity. The other is the quantitative tightening. The Fed is pulling out of the bond market through its QT, and that means some other buyer has to step in. It turns out that buyer are hedge funds, and hedge funds are obviously very price sensitive. They're there when things are going well, and they immediately leave when things aren't going that well, and that creates a lot more volatility, makes the bond market more fragile. So in this high rate environment with that QT, that's a flashpoint. That's a stress line in the system that could be a problem if the Fed keeps rates here too high for too long.
As we were taking a look at one more component within this that had been part of this sticky inflation kind of narrative that we had seen report over report, essentially, that moved a different direction and offset housing. It was energy. That's going to continue to be kind of one of the more volatile pieces, perhaps, of this. But is there some stability that energy could even bring to the inflation print on a go-forward basis from here?
Well, as you point out, energy prices, particularly oil prices, go up, down, all around. So that always makes me nervous. I mean, that's the one thing that could upset the apple cart here. But having said that, it does feel like oil prices should stay down. I mean, we're getting a lot of production coming out of the U.S. The frackers have done a marvelous job ramping things up. Here in the U.S., we're producing well over 13 million barrels of oil a day. Brad, just for context, the Saudis and the Russians are producing 8.5, 9 million barrels a day. We're the largest oil producer on the planet by orders of magnitude. And that's helped to fill the void left by the Russian sanctions and OPEC plus production cuts. So that's helped quite a bit. Also, global demand has been on the soft side. Given the weak Chinese economy, given the move here to hybrid and EV, reducing the demand for gasoline to power our cars. So that all augurs well. But having said all of that, I really worry because there's a lot of cross currents, global demand supply factors that affect the price of oil and could blow in the wrong direction here. But right now it feels okay. It feels we got a tenuous kind of a calm here at the moment.
Mark Zandi, always a pleasure to grab some time with you, and thanks so much for breaking down this CPI report with us. Moody's Analytics Chief Economist. Great to see you, Mark.
Thank you.
Well, shares of Delta Airlines are plunging this morning as the airline misses on profit expectations for the third quarter. Now, profits for the second quarter, they also came in just slightly below analyst expectations. I had the opportunity to speak with Delta Airlines CEO Ed Bastian, and he touted the company's record revenue for the June quarter and said that summer travel demand remains very healthy. He did have something to say, though, about where the company is seeing some challenges within the consumer. Take a listen.
Our consumer is very healthy. Our consumer tends to be a bit more affluent. Our consumer tends to have more discretionary wealth and purchasing capability. Our consumers tell us that one of their top purchase drivers for their wealth, their funds, are to continue to travel. So our consumers are driving the experience economy, and whether it's traveling to Europe to see a Taylor Swift concert or going to see friends another part of the country, that's driving a tremendous amount of our stability. I do acknowledge that in the lower end of the consumer ribbon, that's been a more challenging picture for the airline industry, and that's probably what led to some of those price declines that you mentioned. Last year was really, really high. But as supply came back, you're starting to see prices start to match that accordingly.
Always great to hear that Taylor is still very much a part and perhaps core driver of some of the experience economy right now, especially with some of the touring still taking place. All that said, and jokes aside here, this is a quarter where you look across the TSA passenger throughput data that we've seen over the course of this year thus far. The number of passengers who have been in air or going through these checkpoints, it's running above those 2023 markers, which was the post-pandemic high and also set some new records of its own. 2024 is outpacing 2023 by about 6%. So that's just about 146,000 passengers every single day. And so as you're thinking about that and as you're thinking about where this consumer is pushing back, it also comes back to some of the routes that Delta is running to here. So that is something that certainly could challenge margins, not just for Delta, but for the industry as a whole. And I wouldn't be surprised if we heard something similar from United Airlines, from American Airlines as well here this quarter.
Yeah, and I think when you take a look at the stock's reaction here to this print, I mean, you're looking at losses of nearly 9% in shares this morning, and you're seeing that across the board when you take a look at peers. And the reason why is because, yes, there are reasons to be optimistic about what happened last quarter, but when it comes to current quarter trends and some of the commentary that even you mentioned on the phone with you last night, Brad, is pointing to the fact that consumers are under pressure. These airlines simply don't have the pricing power that maybe they did over the last several quarters. We're seeing that reflected in margins. We're seeing that reflected even in demand numbers here today, or in those guidance numbers. So because of that, that's obviously a bit worrisome on the street and a huge reason why we're looking at the stock under a tremendous amount of pressure here this morning.
Yeah, in tandem with the results here, I also was able to ask Ed Bastian about Delta's expansion into the international markets. Now, he touched on the company's investment in LATAM Airlines to expand in South American markets. Here's what he had to say about that.
While that region has been probably or was a bit slow to recover from COVID, over the last couple of years, it's been recovering quite well. and we've expanded pretty aggressively. Whether that's the South American markets, whether it's Latin America, whether that's Mexico, those markets have seen a lot of capacity growth. We're happy with that because we realize that those are markets that our market share opportunities are pretty important to us, and we want to capitalize on them. But it also drives pricing down as, again, all the capacity comes back and gives what is certainly a price-sensitive consumer in that region opportunities to travel more.
And so no question, yeah, a flight going overseas to Europe going to cost more than a flight going to Latin America. And typically what that means as well is that that's going to add a little bit of compression onto the margins, year over year tough comparisons. And that's where we were kind of getting back to what the company is expecting for the third quarter here, looking at this range of about $1.70 to the high end of $2, which compared to the same quarter last year, came in at about $2.03. So it is still a decline year over year that they're forecasting, even at the top end and especially at the midpoint. And I think that's what the street is really looking at here today. If there's still continued demand around international travel, and there is, even prompting Delta to net a new partnership with Riyadh Air, which hasn't even had their first flight yet. That's expected in 2025. But it goes to show the ambitions that Delta has to scale out internationally, but also understanding where there might be some flights and some routes that are not going to be as profitable as others, especially when you do have a comeback into that region and a resurgence into that region as a new option for international travel as compared to when people were going gung-ho to Europe last year.
Yeah, and I think that was reflected also in his capacity growth outlook, right? Just in terms of where they are seeing that opportunity, certain routes that they aren't seeing demand, and as a result are making those changes to better, obviously, in the attempt to boost their business and have the right flight maps in place in order to get the best bang for your buck, and also just in order to try and boost that bottom line here going forward. So I think that's also the real question here on the street, as they had discussed some of that capacity growth and exactly what that's going to look like, and overall moderation going forward, just where those further adjustments maybe are going to be here in the second half of the year.
Absolutely.
All right, another stock that we're watching this morning is Pepsi. Shares moving to the downside after the company saw softer demand for its snacks and drinks here in the second quarter. You're looking at a loss of just about 2%. Of course, when we take a look at this print, the big question is what this tells us about the consumer. Clearly, it shows that consumer is still under a bit of pressure. Consumers are cutting back on some of their spending, especially on what they are spending on snacks. That was very evident within this report. Also, after years and years of price increases and some sales growth, it does look like Pepsi business might be struggling just a bit, but consumers maybe are, there's a bit of a backlash just in terms of the willingness maybe to spend on those higher prices at the moment. We're seeing that reflected in these results here today.
Yeah, it's amazing when you kind of look through, and for all of the talk that we've heard around shrinkflation, I mean, it's even made it all the way to the presidential lecterns at certain appearances and speeches that the president has given. All of this is going to be more in focus for consumers as they're especially trying to figure out where they're either buying in bulk for some of the typical snack purchases that they may have made, or drink and soft beverage purchases that they may have made before. But for PepsiCo, it's also a larger kind of inclination as to where they need to sell into some of their B2B clients as well to offset where the consumer pushback may be. And I think that's part of the calculus that this executive team really has a lot of potential work to do, because even if you see more consumers saying, all right, we're not going to buy as much of that same product, or not going to stock up the pantries the same way, but we're also not going to go out, and that's going to mean that some of the food and beverage service industry companies are not buying the same quantities, then you're getting hit on both sides, both the restaurant and the retail side of the business too.
Yeah, exactly. You can see it reflected just strictly in the volume numbers. You got Frito-Lay North America, that volume off 4%. Quaker Foods North America volume off 17%. Some issues there, obviously. Latin America Convenient Foods volume off 6%. So really declines here, pointing to the fact that consumers under a bit of pressure as a result. They aren't going out and spending some of those higher prices that many of these consumer staple companies have enacted over the last several quarters when you talk about those price hikes. So we're seeing a bit of a pushback, and as a result, volumes really heading in the wrong direction.
Big hit on Quaker Foods in North America here. Not as many people eating oatmeal, I guess, these mornings.
It's a staple in our house.
My dad used to eat it every morning. All right, guys, we're just getting started here on the morning brief. And if you're my dad, you're probably just warming up your oatmeal. Coming up, inflation hits Costco. The retailer retailer is hiking its membership fees. We've got some top trending tickers coming up next. Plus, later on, Walmart betting big on artificial intelligence. They sell oatmeal there, too. We're going to hear from one analyst who believes that the retailer could be a key player in the AI arms race, though. All this and much more. You're watching Yahoo Finance. Time for some trending tickers. Costco shares climbing this morning after announcing it's hiking its membership fees for the first time since 2017, effective September 1st. Members of U.S. and Canada Gold Star Business and Business Business add-on rather, will pay $5 more for their membership. Now that brings the new annual cost to $65. You said this wasn't a big deal in our morning meeting.
Well, it's not a huge, in terms of the fact that maybe that price increase could have been a lot more.
It could have been.
It's $5. Yes, I'm not discounting the $5, but if you are a loyal Costco shopper, I don't think you might be too upset. Maybe I'm wrong about a $5 hike when it comes to the membership fees. And the reason I bring that up is because Wall Street has been waiting for this to be announced now for several quarters. Every single time earnings season rolls around, it's almost the first or second or third thing that's asked is about membership fees and how big of a catalyst this could potentially be for the stock. And there's been a number of analysts who have run through the numbers saying that there has been outperformance in Costco stock leading up to the membership hype because Wall Street then starting to price that in ultimately what that's going to mean for the bottom line. So again, that's why we're seeing some excitement in shares here this morning, just in terms of maybe how big of a boost this is going to be to Costco in the quarters to come. But again, this has a move that we have been waiting for quite some time. I don't necessarily say that we were personally excited about it if you're a Costco consumer, But again, if you're an investor in Costco, what this will ultimately do to the business in the long run, that's something to be excited about.
Fair enough. I'm just saying, divide it up. That is 3 1/3 hot dogs that you're missing out on every month.
That's true.
Because you're paying that $5 extra here. I don't know. Might be good for the waistline, but Costco probably reading some of the tea leaves of consumer purchases. If you can purchase gold bars at Costco, you can probably afford to pay a little $5 extra per month.
All right, let's take a look at Conagra because the stock is under a bit of pressure here this morning, hitting a 4-month low in pre-market trading, off just around 1.5%. The company missed on its fourth quarter revenue. Also, its outlook coming in a bit underwhelming here for the street. When it comes to quarterly net sales, that fell about 2% from just about a year ago. And when you take a look at some of the other areas here, volumes overall declining 1.8%. So again, a similar theme to what we just talked about in PepsiCo a few minutes ago, a drop in volumes heading in the wrong direction, a bit of a pushback here from consumers as they do adjust some of their spending patterns there, Brad.
Yeah, absolutely. I mean, let's remember, Conagra Brands really does touch the core of households here at the end of the day with some of the brands that they have underneath of their belt. And I think taking a look at the year-to-date performance here, it was up by about 0.5%, it looked like, but over the past year, down by about 12.5%. This is another one of those kind of key brands, in addition to PepsiCo, to watch, especially as they're trying to give us some insight into where the consumer is continuing to push back in certain product elements here. And I think similarly going forward for investors, they're trying to figure out, all right, for all of these companies that have leaned into making specific acquisitions over time to build out the brands that they do own, where might they actually have to deploy even more capital to acquire that next brand or to acquire that startup that may be able to add into the existing portfolio of brands that they have? Just to put some names on this, I mean, people out there who are tapping into Slim Jims or Hunt's tomato sauce or Ready Whip, yeah, these are all Conagra brands. And so at the end of the day, if people are pushing back on how much they're willing to pay on Orville Redenbacher's popcorn, then that spells out problem for Conagra, at least in the near-term period of time.
All right, let's take a look at Darden because Darden falling after Jefferies downgraded the stock to underperform from hold. Slashed its price target as well. The analysts there citing near-term challenges for Darden's fundamentals. So that's a bit of an overview here. But again, essentially what this analyst is saying, and this is the operator of Olive Garden chain, a number of eateries there, basically saying that because of some of the pressure that customers are facing right now on their wallets, the fact that they don't have as much spending power maybe as they once did, that is going to then hurt names like Darden. And as a result, they lowered their price target to $124. That was down from $154. What exactly that means in terms of pricing action, they're saying that they think shares could decline about 10% from yesterday's closing price. They're also saying that the rising promotional intensity could see Darden lose some of its share. So again, important things to keep in mind. We're seeing a bit of pressure here on Darden.
Yeah, this new target is essentially a 10% downside from that Wednesday close here, and the risk, as you were mentioning, to near-term fundamentals, the analyst citing here in this client note. Also, everyone, we've got the opening bell coming up. Let's do a quick check of the markets here as we're keeping close tabs on the NASDAQ, the Dow Jones Industrial Average, and the S&P 500. We've got much more on that here as we're taking a look at the major averages. The Dow right now and the NASDAQ moves into positive territory. We are mixed, though, coming off of that CPI report. We're going to go to a quick break, and then we've got the opening bell. All right, the opening bell hath run its course. Anyway, it's rung on the Wall Street, the NYSE. Things are thrown off when I can't see who's ringing the bell. Anyway, NYSE, they rang it. NASDAQ, they rang it. I believe they had funfetti somewhere in there. And we're taking a look at the opening cross here that has happened as well. The Dow, the NASDAQ Composite, and the S&P 500, as they were trying to make up their mind here this morning, they were negative, then positive, and positive, then negative. Ultimately, they open up the day higher here, flat, just barely to the upside here as we're taking a look at the Dow Jones Industrial Average, holding on to gains right now about 0.05% early in trade.
Yeah, let's take a look at the bond market's reaction too. You've got the 10-year off just around 9 basis points to 418 below that 4.2 level. You're also seeing the reaction play out on the 30-year bond market as well. Taking a look at some of that sector action and reaction to that CPI print that we got here this morning. You're looking at real estate materials leading the way. Real estate really by far the leader here today, up just around 1.6%. On the flip side, taking a look at the laggards, you got energy and consumer staples pulling up the rear. Jared Blickery has a closer look at this movement that we're seeing. Jared.
Yeah, so let's not forget, we got a nice winning streak in the NASDAQ Composite, the NASDAQ 100, and the S&P 500 going on. I believe it's going to be 8 days today, so that is in the balance right now. Here's the last 10 days. You can see S&P up about 3%, quite respectable. And I like how you were emphasizing the 10-year T-note yield. That has now hit the lowest in a couple of months. So let me just bring up that chart real quickly. This has some important implications for which sectors are outperforming today. And here you see, we are actually at the lowest in maybe it's 3 months. Nevertheless, definitely on the way down here. And that just it's kind of a release valve. It just makes the market participants more confident that the Fed will be able to cut sooner rather than later. And looking at the sector action, I said this, the 10-year T-note yield dropping had important implications. We're seeing that with real estate. Shauna, you were noticing that real estate is by far the biggest performing sector. Then you have materials and utilities, another interest rate sensitive sector, then consumer discretionary. To the downside, energy, the biggest loser, down about 0.4%. And speaking of winning streaks, I just wanted to catch Tesla real quick, if I can find it. There we go. Up about 17 basis points. And it is in the midst of, I believe this is going to be day number 12. Anyway, here's the last 10 days. You can see it's up 34%. The big resistance level I'm looking at is 300. That's a little bit farther away than we've gone right now, but every 5 points or so, every $5, you could pretty much say that's a new resistance point until we get to 300. Also wanted to spend a minute on regional banks. We've been seeing these perk up over the last couple days. This is what happened this morning. And let me just show you the last 2 days, adding to those totals there. Just kind of interesting. This is another perhaps interest rate play. Banks love the Fed cutting rates. So that's probably as simple as it is right there. We can also check out the big banks. Now, this is over the last 2 days. We're seeing some red there, and today some more red. So JP Morgan down about 0.9%. And it looks like that strengthened banks, really some of the mid-sized guys, not the big ones.
All right, Jared, thanks so much. Let's take a look at that broader market reaction again. We're still looking at, actually now at a mixed picture. You got the Dow just below the flat line. You got the S&P and the NASDAQ pushing to the upside. The movement here coming after inflation cooled more than expected during the month of June. But is the reading even more important to the Fed at this juncture? And what ultimately does that mean here for Fed Chair Jay Powell's path here moving forward? For that, we want to bring in Callie Cox. She is Ritholtz Wealth Management Chief Market Strategist. Callie, congratulations on the new job. Great to have you back here on Yahoo Finance. So talk to us just about how you're looking at this report and also what the muted maybe reaction in the equities market, what that signals to us.
First of all, thank you. I'm so excited to be representing Ritholtz. It's an amazing firm. And, more excitedly, we got another CPI report that points to celebratory rate cuts, potentially in September. What we saw today was basically inflation coming down, but not too quickly. And that's exactly what the Fed wants to see, especially as weakness creeps up in the job market.
How many more reports like this does the Fed need to see, Callie?
Well, that's the big question. Powell won't tell us, and that's kind of his MO. He doesn't give us, hard numbers or projections. But they do have 2 PCE reports and 2 CPI reports before the September meeting. So a July rate cut is probably too quick, but I'd expect to see Powell prompt us, really hint toward the potential for a rate hike through a rate cut through changed language in July.
Callie, if we were to see rates lowered, what do you think that could tell us about participation? Could we see more participation as a result?
Well, I think rate hikes have restrained this bull market so far, and rates coming down, with this economic backdrop, we probably won't see rates come down too much, but just a little bit of relief on the bull market could let it live a little bit more. We could see stocks outside of tech actually participate in this bull market, and the small caps and mid caps, which have lagged for so long, could potentially catch up.
And so with that in mind, I mean, where are some of the other areas, even as we're trying to wait for the catch up from small caps and mid caps, if there was an overflow from some of the rotation perhaps that takes place out of the AI trade and into other sectors, what are the sectors that are most ripe for getting some of that windfall?
Well, I think you have to look at the rate sensitive sectors, right? You're seeing housing. I know Jared mentioned a minute ago that banks are seeing a bid this morning. You have to think about those sectors that have been pummeled for so long from higher rates. And, if you think about who I'm serving right now, we have longer term clients. They're looking over years. And what we've been telling them is that there's a lot of value in this market in those sectors that have been hammered by higher rates and aren't necessarily damaged for the long term. If you have some time on your side, this might be a good entry point, especially as, the rest of the market starts to breathe.
Kelly, there's been so much talk about the concentration within the market, the need for broader participation, how much is riding on a handful of tech stocks, especially this earnings season. How are you looking at that, and how big of a risk maybe this poses? Does it pose a risk to the broader market, do you think?
Well, we need to see earnings follow through. Of course, one of the reasons why tech has been so favored recently is because it has been one of a few sectors driving this earnings recovery. And to a certain extent, market concentration is natural. Usually people invest in what's doing well, and tech has been doing exceptionally well recently. But as this earnings season comes upon us on Friday, as we see a little bit of broadening, we need to see the fundamentals, show a case for the rest of the market outperforming.
Callie, as we're kind of beginning this second quarter earnings season here, what do you expect the outsized theme that we may hear from companies might be?
Well, I'm interested in hearing about, this is always the case, but I'm interested in hearing the commentary from management. I think the results matter a little bit more this time around because, like I said, we need to see a little more success in companies outside of tech actually, posting sales beats, posting earnings beats, but more importantly, sales beats. And, when I'm thinking about management commentary, I want to hear what management teams are thinking about the future, but especially when it comes to CapEx and plans to expand and, what they expect from the rate environment. More of that talk that you'd expect in bull markets that we haven't really gotten yet.
Callie Cox, Ritholtz Wealth Management Chief Market Strategist. Callie, great to see you again. Thanks so much for hopping on.
Thanks for having me.
Certainly. Coming up, everyone, we've got a deeper dive into Delta Airlines Q2 results. We have analyst reaction on the other side of this break. You're watching The Morning Brief. One of the biggest first earnings reports of this season is Delta, and shares of Delta Airlines moving lower this morning. The company posting a record June quarter revenue, but they say that discounted airfares pressured earnings, which fell below analyst expectations. I had the chance to catch up with Ed Bastian, the CEO of Delta, to discuss the company's report, and this is what he had to say about the company's guidance. Let's listen.
Well, relative to consensus, we're guiding to a little bit of a lower range. It's exactly what I just mentioned in terms of the domestic market weakness in the lower fare category, the discounting, particularly in the lower fare airlines. The good news there is that that capacity is anticipated to be back in balance by September, and we see the industry pace with the supply coming out, and that will enable us, we believe, to be unit revenue positive in the month of September domestically.
For a deeper dive into Delta's earnings, we're joined by Nicholas Owens, who is the Morningstar Industrials Equity Analyst. Great to have you here on the show with us. All right, so are the street's expectations of Delta just too lofty, or is this kind of a symptom that we're expecting now, given where the consumer is moving?
I think maybe a little bit too lofty, yeah. What you've had over the last couple of years is just this record demand, record prices, and basically I see that as leveling off. And my fair value on Delta is $39, so kind of coming in closer to where I thought it would be. The quarter really didn't surprise me, and that the key story really is a little bit of price softening, as you heard from the CEO.
Nicholas, it seems like the read, at least from the street, is that maybe this signals the fact that there might be some concerns about the health industry-wide. Is that the right read here, and why or why not?
Well, Delta is kind of the leader of the pack. They're the first to report, and they have really the most, say, successful customer segmentation that allows them to record record or premium revenue and really great margins. I mean, 15% operating margin is quite enviable for an airline. And so if they're saying it's going to be a little soft in the next quarter, the assumption is that other airlines will be even softer.
It sounds like some of the demand, though, still remains strong among their consumer, which the CEO, Ed Bastian, pointed out to me is a more affluent consumer, is one that's looking to spend on things like prioritizing international travel. It's just kind of where those international travel routes, I guess, are in comparison to what we were looking at last year, when there was a lot of still the revenge travel that was in the tape. And it seems like some of that has moved towards the Latin America division, which saw revenue move higher by about, 4% in this most recent quarter.
Yeah, again, and so there's still plenty of demand for travel. You know, they're filling the planes. I think of it as a little bit of a barbell, in the sense that you still have, all the premium seats and so forth going well, but the price war, if you will, is happening in the back half of the plane. Where Southwest is cutting prices, and they're also under pressure from the even more discounted airlines.
Nicholas, when it comes to, I guess, some of the commentary coming out from management just in terms of capacity growth, that is going to be moderating here going forward, how big of a boost do you see some of those adjustments being to their business here, at least in the second half of the year? Or how quickly can we expect that to trickle down?
Well, they're targeting 3 to 5% capacity growth in the second quarter, and only 2 to 4% revenue growth. So, and 2 to 5%, or whatever that is, 3 to 5% capacity growth is pretty slow compared to the last few years. You basically were lapping the 2019 capacity levels, and basically coming off of these sort of record high revenue yields.
Nicholas, while we have you, one of the huge things that actually kind of jumped out to me in my conversation with Delta was really around some of the hiccups that they're seeing right now, or at least the headwinds that they're seeing, I should say, within manufacturing. And I believe what he had mentioned to me is that some of the maintenance is stretched. You're seeing some of the aircraft reaching or getting closer to maturity, and this is going to be a several-year process to try and fix. How much of an overhang for the entire industry, Delta included, is that?
Yeah, I think it's important to note, as you do, that this affects more or less the entire industry. Southwest has a unique exposure to Boeing aircraft, but in general, new planes are delayed, even from Airbus. And so you'll just see them holding on to some of their older planes for a little longer. Those planes are a little more expensive to run, a little less fuel efficient. And then, they require maintenance that is also then a little harder to come by with higher maintenance costs and part shortages in some spots. So, but that's just a little bit of friction, let's say, that the whole industry will experience.
All right, Nicholas Owens, Morningstar Industrials Equity Analyst. Thanks so much for joining us here this morning.
Thanks for having me.
All right, coming up, we're taking a closer look at some big food and beverage companies reporting earnings this morning. We'll break down what these reports signal for the current state of the consumer. You can see PepsiCo and Conagra Brands, both of those stocks under pressure following those results. Conagra Brands off nearly 4%. More on why next.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
How is weak consumer demand impacting food and beverage companies? Some earnings reports out this morning giving an early preview. We got results out from Pepsi reporting weak consumer demand in North America in its second quarter report and lowering its full year guidance. To discuss what these reports signal about the state of the consumer, Yahoo Finance's very own Brian Sazzi. And Sazzi, it looks like the street's a little worried just about some of the guidance that we got here from Pepsi.
Yeah, a little worried, but you ultimately don't come to me to break down the numbers and go and pull up that earnings release. Bottom line is with PepsiCo, global volumes down for 8 straight quarters. Not going to be well received by investors. You go to Conagra Brands, weakness in the snacks business, weakness all over parts of their business, maybe except frozen food, whatever it is. But what really I think is jarring was this earnings call from PepsiCo led by CEO Ramon Laguarta, and he really kept it real. He said consumers are pushing back on higher prices, and now the company is going to have to go back and figure out ways to offer them more value. Now, I caught up with Ramon just a couple moments ago, and we talked a lot about what value means. And it's not necessarily going out there and making a bag of potato chips cheaper, cutting the price on it. It might be on a multi-pack, offering 2 bags free. It might be adding a couple more chips into that bag. Whatever it is, look for the company to become more aggressive on getting customers back into its PepsiCo universe, Frito-Lay, Doritos, you name it, by offering them either more in their packages or, in some cases, cutting prices. And I think that will also apply to their beverage business. In addition, I would not be surprised if you see a new round of cost cuts at PepsiCo over the next 6 months. Company is notoriously drilling down in cost to keep its margins some of the best in class on Wall Street. I wouldn't expect anything too significant, but again, I think the company is very margin focused given the weakness they are in fact seeing in volumes. Ultimately, I think you take this quarter from PepsiCo and start to think now, if you're out there trading retail or consumer names, how might this show up in the earnings out of a Walmart? How might this show up in earnings out of a Target? Keep in mind what we have heard from Walmart in recent quarters. Sales strength in upper income households, but PepsiCo saying now they also are seeing consumers push back. And of course, Brad, you talked to Delta CEO Ed Bastian calling out consumer weakness of its own. So a lot of alarm bells. I know we're early on in earnings season, but right off the bat, there are a couple key trends or catalysts, Shauna Smith, that investors need to know.
Where are the weight loss drugs?
Yes.
Being a key trend.
Yeah, hot debate. We really had a somewhat of a discussion about this in the Yahoo Finance newsroom. Miles Udland very focused on this as a key impact to a lot of packaged food volumes. Now, Ramon said his company has been doing a lot of study groups, really drilling down into this. And I think Ramon falls to my side of this argument is that these drugs are still for upper income households. Lower income households do not have the financial funds or means to go out and purchase GLP-1s. And right now, a lot of that consumer weakness is coming from lower income shoppers that are more price sensitive. Not yet. I believe Ramon was saying that he's not seen a material impact on its business from GLP-1s. Now, bottom line, is this something to watch over the long term as these drugs come down in price? Perhaps. Is it 5-10 year impact, something to watch? Perhaps, but right now, I think the bigger concern is that inflation has built up in the packaged good industries over the past 3 to 4 years, and now these companies are going to have to figure out ways to reduce prices, get customers back shopping their categories more.
I was going to say, is that a trend that you expect to hear now in the coming weeks as we do get more results from so many of these consumer staple companies when it comes to some of the pressure, some of the pushback? We have been talking about the time that this was going to ultimately come. It sounds like at least from these early reports, we are starting to see hints of that. So then should consumers or viewers out there expect maybe more deals or more incentives down the line?
They're coming. Pepsi has already started to ramp up its promotions in the past few weeks. They have started to see an improvement, I think, in some parts of the business, but expect more. And it's not just a PepsiCo thing. I would expect you're seeing this from a Conagra Brands. You're going to see it. If you haven't seen it already from Coca-Cola, you'll probably hear some of this commentary from Coke when it reports. You'll probably hear it from Target. Where actually I didn't see it was interesting was those Costco results, monthly sales results for June that the company announced last night. I think those results got overshadowed by the membership fee hike, as you would expect, but nonetheless, you had strength in consumable goods. You had strength, too, double-digit increases in jewelry and non-food categories, which was pretty interesting. But overall, not a good start. Not a good start to this earnings season.
That is true. Certainly some red flags there when it comes to the consumer. While we have you, what did you think of that Costco news? Finally, finally got that right.
I was writing enough about this when I was just a cub reporter, 4 or 5 years ago. We were looking for another membership fee increase. 7 years since Costco last raised its membership fee increase. Usually the stock performs very well into a release like this as people expect an earnings boost. Costco shares up 35% 5% year to date. Usually the stock underperforms the S&P 500 after the fee increase is released, usually because profits don't get the big bump as many people expect. No surprise you're seeing Costco shares down after the fee hike. I think this is fine. This is what Costco does. They're not going to lose any customers. They're going to take this fee increase, go back in, lower prices, gain more market share, and just keep on winning. That's what Costco does.
There's a lot of overlap in the Venmo diagram, or not the Venmo, the Venn diagram between Costco and PepsiCo. Bringing it all together.
There's a lot of PepsiCo being sold in Costco for sure.
Yeah, absolutely. A lot of Quaker Oats too.
I love Costco. I love Costco.
It's good.
It's great. You get like fish. I can get like salmon like this size. It's like this
Don't
size.
you love the salmon?
It's
One
like
of you
this
guys love.
size.
Maybe it's you.
You're not getting salmon that size.
Yes, you are. That is not fake news. Like I will go
I
down
would
and
have
take a photo
questions
for
if you were getting salmon.
It's this
that
size. The fish is
all
this
right,
size.
Saz. Always great to have you.
Fishmongers just tossing the salmon.
It's just this size. They toss it to me all the time. It's just this size. No GLP-1.
Well, that would be
impact
enough
miles.
salmon
Sorry.
for
No
like
GLP-1
a
impact.
month for you. All right, Saz, thanks so much for hopping on with us here, discussing all the big topics that everyone needs to know. Keep right here on Yahoo Finance. We got much more coming up on the other side. Catalyst starts at the top of the hour. We'll see you then.
Love that.
Just after 10 a.m. here in New York City, I'm Shauna Smith alongside Madison Mills. Let's dive into the catalyst moving markets today.
Inflation continuing to moderate in June. The consumer price index headline number falling by 0.1% since last month. Markets now pricing in a higher chance of sooner rate cuts. So we'll discuss what that means for the Fed's path forward.
And earnings from Pepsi and Conagra brands showing some signs that the consumer is weakening. We'll discuss what this signals or could signal for the broader economy.
And President Biden faces another critical test as he is set to close out the NATO summit in Washington with a press conference this evening. We'll dive into how critical this event is for Biden, especially after losing support from key fundraisers, including George Clooney. But first up here, we got to talk about the market's reaction to that June inflation print coming in softer than expected. Now, futures initially did jump following the data coming out, and since they've seesawed a bit, you're looking at gains across the Dow and the S&P up just 0.1%, the Nasdaq moving just below the flat line there. Now, for all items, we did see inflation decline 0.1% month over month versus 0.1% gain economists were expecting. So joining us now on this, we've got Krishna Mamani. He is Lafayette College's CIO. Krishna, thank you so much for being here in studio. We really appreciate it. What does this mean for when the Fed is going to cut is the key question, right?
Yes, definitely. The issue, though, I think what it is implying is September is in the bag. But we have to remember that there's still substantial time between now and September, and lots of reports that can come in that can put a little bit of a damper on things, as we saw in the first quarter of this year. Having said that, I think the trend has been pretty persistent, and the likelihood that they cut in September is quite high. From a market's perspective, though, there are a couple of other issues to be mindful of. One, valuation levels for equities. Yep. And the transition from a soft landing to a recession is not as gradual as people expect it to be. And I think, as you see from the consumer, if you continue to see signs of that, I think people would start questioning the growth trend, specifically the nominal growth trend, and which is probably the most important thing for earnings, which need to be really spectacular to support these valuations.
So then does that tell us that maybe July should be on the table?
I think July should have been on the table based on today's report, but I think the Fed would like to tell you ahead of time what they're going to do. My expectation was that they probably won't tee up September, but I think given today's report, it's quite likely that they tee up September.
When do they do that?
I think after the meeting, they can bring in all sorts of people throughout the next few months to kind of job on the market into that positioning.
Krishna, Chair Powell's comments down in D.C. these past few days have largely been characterized as dovish, and he was talking about some of the weakness that he's been noticing, and many economists and here on our program have been talking about some of the weakness that we've been seeing. The numbers clearly put it in the labor market. I'm curious how you're looking at that, and the longer we do see the Fed wait to cut rates, how much higher we could see that unemployment rate go.
Well, so I think the trend in the labor market has been quite consistent. It's been slowing down for a reasonably long period of time. The question really is, would July versus September, would that really make that much of a difference in the state of the economies? And I think in the Fed's judgment would be that it probably doesn't. So I don't think it changes the picture for what they are going to do. And employment is their second mandate, and that's what Powell was talking about. So I think given everything that we see today, September looks a lot more likely than it would have otherwise.
When would it change? If it were to wait to December, would then we see more material weakness within labor market?
Well, so I think the risk is, and the risk that they worry about a great deal is they basically extract a loss from the jaws of victory. That is, because they waited as long as they did, the economy actually is in a downward trend and accelerates that. I don't think that would be the case. That is certainly not the base case, but I think that's something that is in the back of the Fed's mind, has been in the back of their mind, and that's why they started talking about things in November, because they didn't want to be too late.
This is going to start like a politics question, but I promise it's a Fed question because there's so much political volatility right now, obviously, and uncertainty. Does that spotlight on the Democratic ticket take any of the pressure off of the Fed around looking too political because they don't even know which candidate they're potentially backing?
I think the Fed has been, at least Jay Powell has been very clear about that they don't do politics. And I think we have to take them at face value. If the numbers come out the way they have been coming out, the likelihood that they don't cut in September because they would look political one way or the other, I don't think that's something that we should assign a great probability.
But people might, right?
People might, but I think he will have to kind of defend his position in a meaningful way, and I have no doubt that they will. But I think in scheme of things, they have done things in the past in these types of situations, and I think for us to expect that they would do something else when the economy is slowing down the way they expected it to, and they have kind of laid out the path for us already, I don't think that's very likely.
Christian, when it comes to some of the trends that we've been seeing within the economy, I guess, are you convinced that this disinflationary story is intact? And it seems like largely consensus right now is yes, obviously on the heels of this print. But I'm curious, in terms of the future prints that you are watching outside of inflation, what do you think is the most important metric to keep an eye on?
Well, I think the inflation part, even if it accelerates for 1 or 2 periods, I don't think that gets the Fed that worried. I think right now the baton, the kind of their thinking baton has moved to employment report far more than inflation. So if employment kind of reaccelerates for some reason, I think that takes away the incentive to cut, because at the end of the day, what they want to do is make sure that the economy doesn't go into a severe slowdown where they are forced into cutting very aggressively.
All right, Krishna Mamani at Lafayette College, a Chief Investment Officer. Thanks so much for joining us here on set.
Thank you.
Turning now to President Biden facing a key test as he's set to close out the NATO summit with a press conference at 5:30 p.m. Eastern time today. This coming as he just lost support from actor George Clooney, the actor writing in an op-ed for the New York Times, quote, "We are not going to win in November with this president," and calling on top Democrats to ask Biden to voluntarily step aside. We also had Senator Peter Welch also calling for President Biden to step aside in the race. He wrote an op-ed for the Washington Post. This is significant because it's the first Democratic senator coming out calling for President Biden to step aside in the race. So where do we go from here? We want to bring in our very own Rick Newman. And Rick, it's another day and more pressure, obviously, continuing to mount here on President Biden to step aside in the race.
Senility watch continues, I guess is the way I would put it, regrettably. So Biden has this press conference today at 5:30 p.m. This is going to be at the end of the 3-day NATO summit in Washington, D.C. This is the type of event that in normal times most people wouldn't pay any attention to. The NATO member nations did accomplish a few important things at this conference. For one thing, they said Ukraine will become a member of NATO at some point. We don't know when, but that is a strong statement of support for Ukraine and its war against Russia. But that's not what people are going to be watching for, obviously, when Biden does his press conference at 5:30. I mean, the pressure is incredible given that we're just a few months before the election here. So Biden has to prove he has total recall of all the names of the people he talked with this week. He's not going to mix up any facts. He has to show that he can keep his train of thought. And he's going to get hammered by the press because, I mean, this is now the cognitive test. I mean, Biden hasn't done the sort of cognitive test Trump claims to have done, which I don't think Trump actually did. But he is now going to face a cognitive test every time he goes on live TV. So we will see how he does today. And I guess if Biden has another slip up like he did during the June 27 debate, I mean, that could be the thing that finally brings his campaign to an end and gets us to a replacement candidate. And if he does really well, I'm not sure that puts any doubts to rest. So a very awkward position for Biden to be in.
Rick, I'm curious about the strategy from the side of Democrats here. I just want to know, in a couple of years when Democrats are chatting at the Thanksgiving table about this moment in time, are they going to look at this as a moment that the Democratic strategy to not fully support Biden was one that lost the election and gave it over to Trump, or as something that was an effective move to save the Democratic Party this election cycle?
I mean, I love the question, Maddie. You're sort of trying to step out of the moment and say, what the heck is actually going on here? I think it depends on the outcome. If Biden stays in this race and then loses to Trump, he is going to be sort of a Democratic villain for a long time, because it's clear that a lot of Democrats want to see a younger candidate. And by the way, there are some very promising younger Democrats. I mean, there are some governors who are very popular in their home states of Pennsylvania and Michigan, for example. There are people in Biden's cabinet who are very capable. And in some sense, Biden just won't get out of the way and let a younger generation step up. So if he stays in the race and he loses, then Biden's a villain. If Biden does step aside, then it depends on whether his replacement wins or loses. So if he steps aside and the next Democrat who steps in defeats Donald Trump, it'll look like, wow, Biden, it took some convincing, but he manned up and he did the right thing. And then if that person loses, it'll be like, oh my God, there's no Democrat who can save this party. So it really depends. I mean, we're really at pivotal moments here on a historic basis during just the next few days and weeks.
Yeah, we got to run, Rick, but it really makes you wonder why we waited to have this conversation now. Thank you so much for joining us, as always. We appreciate it. Switching gears, Apple looking to ease regulatory pressure from the EU. The regulator accepting commitments from Apple to open up its mobile payment system, Apple Pay, to competitors. This deal bringing an end to the EU's 4-year investigation into Apple. And Shauna, what's interesting here, and just for the context for folks who maybe aren't using this to swipe into the metro every day, the wallet lets consumers store your debit card, credit card, tickets to concerts, your airplane ticket. And now third-party developers are going to be able to access the tech that backs that wallet for Apple. So this could be a boon for a Samsung looking to provide their own wallet utilizing that similar technology. Also, other competing platforms like a PayPal, maybe even an Alphabet, for example. And then moving forward, if this does extend to the US in some meaningful way, it could also be an upside catalyst for a name like Square that could develop its own wallet in competition with Apple. But of course, the regulatory question mark here is the key headwind for a company like Apple. And it's interesting to get a sense from this about how they're going to be approaching that.
Yeah, so they've resolved this issue, at least for now, when it comes to some more of those details. The commitment remains binding for 10 years, and Apple risks a fine for as much as 10% of global annual revenue if it does violate this agreement. We know Apple not alone in terms of the tech giants being under pressure by the EU, so this does resolve one issue, but not necessarily in the clear when it comes to some regulatory pressure overseas. So we, of course, will see how all of this plays out. I want to bring up Apple's reaction, though, to this news today, because we're not seeing a massive reaction to this. We also had a call out from Bank of America raising their price target on the stock here earlier. They actually raised it, so we are still down about 1% right now, but maybe cushioning some of that downward decline is Apple, the price target raise, a bit of a more bullish call here from Bank of America, raising their price target to $256 from $230, and they're citing some of that increased confidence of the multi-year iPhone upgrade cycle. So once again, a number of headlines out here for Apple today. So again, it looks like maybe this settlement having more of an impact on the stock right now. But despite that, despite those regulatory headwinds, and you had asked Scott Devitt of Wedbush about the regulatory headwinds facing a lot of these larger tech companies right now, and many of the analysts continue to look past that, at least for now, saying that there's always regulatory pressure. It's just another year, and many of these times, these large tech giants, either they're fined or they're able to work out some deal and move beyond that. It doesn't at least seem to be changing the narrative surrounding the investment side of the story, at least yet.
Right. He said, "Oh, regulation." So that'll be my memory of how Wall Street is looking at regulation, at least for now.
All right, keep right here on Yahoo Finance. We got much more of your market action ahead. Stay tuned. You're watching Catalyst.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
some trending tickers that we're watching on this Friday Eve. Shares of MicroStrategy rallying this morning after the company announced a 10-for-1 stock split. Those shares have surged around 1,000% since the enterprise software company started buying Bitcoin, and that happened back in 2020. The chairman had the firm buying Bitcoin as an inflation hedge. Michael Saylor, who of course has been on the program speaking with our very own Julie Hyman previously. But this stock split, like other stock splits that we've seen recently, is in an effort to make the stock more accessible, both for potential investors but also for employees as well. You're looking at gains of over 4.5% on that stock. It's just interesting to see the continued success of this name, Shauna. Really kind of being able to parlay that Bitcoin purchasing into gains for the stock, and as a kind of way for investors who are looking to allocate some of their portfolios to a Bitcoin style name, seeking out this company in particular.
Yeah, exactly. When you take a look at some of that historical data, just in terms of how companies tend to perform, how stocks tend to perform following stock splits, there were some recent numbers that were crunched by Bank of America when it was surrounding some of that hype when we saw Nvidia's stock split. So it got a lot of people interested just in terms of what exactly maybe we could expect from the stock's behavior here following the split. And they found that an average returns 1 year later of 25% for the stocks that had executed a stock split versus 12% for the broader market there. So stocks usually outperforming the S&P 500 following their split. So something to keep in mind here. And again, we're seeing a bit of a move to the upside here today. Of course, the thought here saying that this is going to spark some more interest, especially on the retail side, for some of these traders here potentially, because of the fact that the stock is going to be much cheaper on that sort of level. All right, let's take a look at QuantumScape here. The rally mode after striking a deal with Volkswagen aimed to mass produce EV battery cells using QuantumScape technology. Yahoo Finance's Praz Subramanian has the details on this one. It's the top trending ticker here on Yahoo Finance today. Praz, we're looking at gains of almost 25% for the stock.
Yeah. You know, deal terms not disclosed here fully, but a huge win here for QuantumScape. VW's PowerCo, which is their battery company, is going to license to build these solid-state batteries up to 1 million EVs worth a year for these batteries. And you've seen the stock move here pretty I mean, this is a massive move here. Yeah. But I want to note that VW is QuantumScape's top shareholder. So this is not exactly a surprise, but still a good deal for them. But look, solid-state batteries are a huge sort of big deal in the EV space right there. More output in terms of power. They can store more electricity, so they can have more sort of bigger vehicles that they can power. And they're lightweight too. You don't have all this like lithium kind of floating around. It's very compact, high output, very new, the future of EVs is going to be solid-state batteries. So this is a big move for them. You know, Toyota also working on solid-state batteries too that can go 600 miles in a charge. I think something crazy like that. So this is kind of big for VW to plant their flag here and get these QuantumScape batteries kind of in their sort of future vehicles.
I want to talk to you about the lithium side of things, and I'm obviously not very familiar with this space, but to what extent is that already being kind of utilized and rolled out within the EV space, or is it something that very much so is future looking?
Well, I should take a step back and say that. So most of these batteries are sort of like these, they have a liquid sort of anode kind of situation going on where it's a heavy sort of liquid-based sort of a material that's in the battery cells. And with this type of technology, solid state, you don't have that. It still uses lithium, but not in a different, in the anode part, the negative part. It's not, and it's this kind of like heavy kind of solution type sort of chemistry. So this is a more efficient. My understanding is it's hard to build these though. The yield rate is low. So I think that's the problem. The problem is, can you make enough of these and make them at cost so they're in parity with these other types of batteries that we see today?
Mm-hmm. All right, Praz. Well, thank you so much, as always, for joining us. We really appreciate it. Our very own Praz Subramanian. Coming up, we've got more on the latest inflation numbers and what it could mean for the bond market in particular. Stay tuned for more. This is Catalysts.
Today's CPI print showing that inflation once again remains the trend, at least continuing to cool as Wall Street debates what this all means for Fed rate cuts. We're seeing that reaction play out in the bond market specifically. You got the 10-year yield off just around 10 basis points, but you're really seeing that reaction across the curve. And actually the 10-year now below that 4.2 level. Here to talk about what ultimately this means going forward, we want to bring in Jonathan Mondillo. He is Aberdeen's head of North American fixed income. Jonathan, it's great to have you on set here with us. So first, just give us your reaction to this print and really and also what is playing out right now in the bond market with the drop in yields this morning.
Yeah, I mean, thank you for having me here, first of all, but a little bit cooler than I think most people were expecting. What does that mean for the bond market? I think bond investors are probably pretty happy when they see, bonds obviously rallying. I think when we talk to investors that have been parked on the sideline, obviously a lot of cash still in money market funds, the question becomes, when do I want to get more fully invested in, we think, credit, and we think credit looks really good right now.
Operationalize what you just said for me. I want to dig into both of those options. So let's say you're parked on the sidelines. What are you advising that folks think about doing?
I think that really depends on whether you're thinking through an institutional investor lens or a retail investor lens.
Retail.
I'd say that we think treasuries are good. Obviously, we see that with the rally this morning. We actually think corporate bonds look really attractive at this moment for institutional investors. But I think the real shining diamond as it is right now for those investors that can take advantage of the tax exemption is tax-exempt munis. They've outperformed on a year-to-date basis. Despite the rally in treasury rates, they continue to compress. We continue to see outperformance. And I think all-in yields on an after-tax basis look really attractive to both treasuries as well as their corporate counterparts.
So what does that upside then look like, do you think?
I mean, you look at the real outperformer thus far this year, it's been high-yield munis. They're up over 4% on a year-to-date basis relative to treasuries, which maybe after today's rally is possibly flat year-to-date. But the yield that you can get on a taxable equivalent basis in high-yield munis is now close to 9%, which we think looks really attractive for what is a really high-quality asset class. Investment-grade munis, also tremendous amount of pickup there. You can pick up about 40 to 50 basis points as opposed to an investment-grade corporate bond. Not apples to apples, the two asset classes, but a good comparative in those yields.
We love a munis chat. People think it's boring, but I mean the returns they're prove themselves. But going back to the broader treasury market, you mentioned folks who are already in and seeing this rally and obviously having a great day. What should investors who are already in the treasury space be thinking about doing?
Well, let's see where they're parked right now. I mean, they're clearly parked short, right? And I think when you look at the rally in rates, that's where we would expect things to sort of pare back as the Fed starts to cut. So I think that investors really need to start thinking about not only what other asset classes are going to outperform treasuries as we get that cut cycle, but also where do I need to be in terms of duration. And we think maybe pushing out slightly in duration makes the most sense at this point in time.
The rally that we're seeing today in bonds, is that at all a bit overextended given the fact that there is still much uncertainty in terms of the timing of the Fed and maybe what exactly this trend for inflation is going to look like in the coming months, even though things are improving?
I think so, and you can look at some of the comments made on Capitol Hill by Chairman Powell, clearly dovish, right? We wouldn't disagree with that, but I think as we go forward over the next 2 to 3 months, you're going to start to see base impact on those inflationary data points and possibility of sticky inflation or even a little bit of volatility in that inflation number. So I think we would probably temper investors' expectations. We're not expecting to see a dramatic fall off in inflation or a dramatic fall off in that growth picture. And therefore, we think that still that cut scenario is going to be much protracted relative to probably where the markets thought entering this year.
I know you're fixed income, but I'm just curious with this inflation data. We're all excited here about, oh, it's cooling. That's great news. But are consumers at home feeling that to the degree that you're able to talk about that? I'm just curious what the read-through is of the data we're seeing to an actual feeling of coolness in the broader economy.
I think to a certain degree, it's probably better today than it was 6 months ago or even 12 months ago. You can see that with energy prices coming down, gas prices coming down. That being said, I think November is going to be a big a bellwether for how families feel when they go to the grocery store, how they feel about inflation. Because I do think, to your point, Main Street is still sort of feeling the impacts of that.
Are you expecting, since we did bring up November, are you expecting increased volatility surrounding the election? I guess in terms of what investors should be pricing in or expecting, maybe in terms of that uptick in volatility, at least it looks like historically speaking that we tend to see that spike maybe happen end of September, beginning of October.
I'd say more likely than not. You can certainly see that with issuance this year. Corporate bond issuance, municipal bond issuance. Corporate bond issuance almost at record levels for the first 6 months. Municipals up 35% year to date. And I think a lot of those issuers are pulling forward that issuance with an expectation that who knows come September, October, into November, what that volatility is going to look like.
Right, volatility across the board with Fed unknowns, White House unknowns, a lot on the table here and globally. So, Jonathan, thank you so much for joining us to break it all down. We
Pleasure,
really
thank you very much.
That was Jonathan Mondillo. He's Aberdeen's head of North American fixed income. Well, shares of Pfizer are on the move here, up about 0.5% after the company announced it is moving forward with a once-daily version of its weight loss pill after seeing encouraging data in an ongoing early-stage study. Yahoo Finance's Anjali Kemlani is here on set with more. Anj, thanks for being here. Obviously, a lot of potential pent-up demand for a weight loss pill. What do we know about the efficacy here, the effectiveness for consumers, and of course the demand picture?
Yeah, so really interesting story for Pfizer, right? As you can see with the movement in the stock today, investors are sort of like giving them a cookie. Like, here's a gold star. You finally got somewhere with another weight loss drug. And so we know that they had to pull back on their twice daily pill earlier. Now they're looking at the once daily. They had about a 50% rate of drop off of the twice daily because patients couldn't really handle the effects of it. So they're looking at the once daily as a potential. Now that could change the efficacy and the amount of weight loss that patients then see. We know that broadly danuglipron has about a 8 to 13% weight loss, and that puts that in the ballpark of Novo Nordisk, right? We know Eli Lilly, for example, has a little bit higher percentage weight loss. So really competitive in terms of that weight loss percentage. Being an oral pill definitely puts it in a very competitive space, but what exactly those results will be and what the dosing ends up being will impact that percentage weight loss, and that is where investors are focused. They've been kind of focused on Pfizer, the broader story, and how it comes back from that COVID win, and that continues to be the ongoing story here for Pfizer.
Anj, how are investors looking at Pfizer's potential to break into this space, given the fact that this conversation has really just been dominated by these two names now for so long?
Well, they are looking at all the other competitors, right? We are going to see a competitive market for the weight loss drugs, broadly speaking, oral pills being a very key part of that competition, because that is where you open up more opportunity for those who may not want to take, weekly injections. And so that's where Pfizer gets to play a role. We also know there's other smaller biotechs in the field, like Viking, for example. They've also come out with pretty strong results for their clinical trials. So broadly speaking, that $100 billion market, there are going to be many players. Whether or not Pfizer can capture a significant portion of that is what remains to be seen. And that is why that formulation is going to be so important. What is that dosing and what is the potential weight loss from that?
All right, Anj, thank you so much. I could talk to you about this forever, but we got to wrap. Thank you. I appreciate it. Coming up here, the newest winner in the AI revolution. It could be Walmart. We're going to discuss why after the break.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Costco is hiking its membership fees for the first time in 7 years. The company announced it's raising its fees by $5 to $65 a year. That goes into effect September 1st. The stock moving lower on the news, off just about 3%. Joining us now to discuss, we want to bring in Corey Tarlow. He's Jefferies' Senior Vice President of Equity Research. Corey, it's great to see you again. So it might be a little bit surprising to some that we are seeing some pressure on the stock today. I'm curious how you're viewing this hike that we're seeing in membership fees and ultimately whether or not this is going to be a catalyst here for the stock.
So we think it's certainly a positive. And the reason is that this is a $250 billion business roughly that virtually makes no money on the products that it sells. So where does it make its money? On the memberships. These memberships are high margin, recurring revenue streams with over 90% renewal rates. And Costco's raised membership rates continually over the last 4 decades since it was founded in 1983. This is the 8th price increase that we've seen on membership in the last 40 years. And over that time frame, they've seen no measurable significant impact on membership renewal rates and membership behavior. So we think this is incrementality to Costco's bottom line and should help drive further earnings growth ahead.
Did they wait too long to hike?
So the historical cadence has been about 5 years for Costco's price increases on membership. The thought was after the first increase or the latest increase that we saw in 2017 was that this would come in about the latter half of 2022. Now, because of all the noise around COVID and inflation, it just seemed a bit off color, I think, to raise the rate at a time when inflation was running at historically elevated rates. And so now I think we're in a bit of a different time here. The value proposition that Costco has is better than it's ever been. Inflation has been essentially zero for the last 3 quarters in the business. And so, and just as a point of reference, the average basket at Costco is $160, and the savings that you get as a Costco member relative to traditional retail when you shop at Costco is $60 on a $160 basket. So the savings are there, the value is there, and the timing, while it could have been earlier, didn't quite seem right at that normal historical cadence.
Corey, do you think we could see BJ's or some of the other competitors out there do a similar type of move?
So we already saw Sam's Club raise its membership fees, and that was about a year and a half ago. The Sam's Club hasn't raised its membership rate prior to the last increase in about 9 years. So I doubt that Sam's Club is going to be raising its membership fee again as a result of Costco raising its membership fee. But BJ's is one that we could see act. Now, we recently hosted the company in Nantucket, so at our consumer conference a couple weeks ago, and it is something that you could think about as a potential catalyst, but it doesn't really seem like it needs to be imminent for the company. BJ's is doing quite well. Traffic is strong. They're doing well on the fresh side and the food and sundry side, and on the general merchant side continues to improve. So there's really not necessarily a need for them to do it, but they could.
I want to quickly get your thoughts on Target, a name that you also cover. Obviously, Target cutting back on some of their prices for really the consumer staples in the store for the summer here. To what extent do you think that is an idiosyncratic story for Target about challenges that they have had with their business? Or is that a broader story about a consumer slowdown that you're seeing across more of the names that you cover?
Well, I think let's look at the unemployment rate, which the latest jobs data, we saw unemployment tick up 4.1% off a historical low level. Balance sheets are still relatively stretched. The consumer is continuing to buy more on credit, and savings rates are continuing to be relatively pressured. So the consumer is stretched, and consumer confidence has been a little bit hurt, and it's at historically kind of low levels here. And so I think as we think about what Target's business is, it's mostly a discretionary business given its assortment. Now they've expanded food in a really big way, which obviously is a need-based item. But in an environment where, I just outlaid the various macro dynamics that we're facing, I think value wins. And the key is marketing around those value messagings, having that attractive price offering that they can have for consumers really helps to draw people in and keep them sticky and keep them coming back. And so I think that's part of the reason that Target's made some of these investments. And they've also been expanding their private label. They announced a new brand called Dealworthy recently, which is really focused on opening price point items at a really attractive prices to help to draw consumers into the stores and in at lower price points amid an environment where admittedly the consumer has been a little bit stretched.
All right, Corey, while we have you, we got to talk Walmart. I know it's your top pick, I believe, within the sector. You recently had some conversations with the Sam's Club CEO out at your Nantucket Consumer Conference. I'm curious what you learned about their AI initiatives, whether or not they remain on track, and how big of a driver you ultimately maybe see this being to their business, to their stock here in the longer run.
Sure. The way we think about Walmart is that it's low prices, but high tech. And one of the things that we really love, at least in our recent conversations with Sam's Club, is this emphasis on technology. And so we obviously really appreciate what Costco's done with their business and what Sam's Club has done as well. But what Sam's Club has done that's relatively unique is that they've added in a lot of technology that I think helps to really differentiate the experience, make the customer experience a little bit better. So everybody knows there's really long lines at Costco. Sam's Club also tends to have long lines, but now they're introducing some technology to maybe find a way around that. And so what we talked about with the CEO of Sam's Club at our Nantucket conference was the introduction of these new technological features called exit arches. And what they are is they are essentially arches that you can walk through with camera technology that essentially can tell you or tell Sam's Club what is in your cart when you're walking out, and you can basically check out on your app. And so you'll scan all your items on your app as you go through the store. You'll swipe to check out like you do online on other online marketplaces. And then you walk out, you just walk out through these exit arches, and then Sam's Club will be able to know whether or not maybe you missed an item. And then they can really be able to accurately tell the contents that are in your cart. And this, I think, helps to remove some friction points, right? Long lines continue to be a problem at club retailers. And oftentimes you have to have someone check your receipt as you walk out. And so this, I think, removes friction points. It increases the speed of checkout by 25%. And Sam's Club also does a lot of surveying of their members. And we found that it actually increases customer satisfaction as well by 15% for every member because they're dealing with slower checkout lines. And so as you think about all this technology Sam's Club's doing, Walmart's doing as relates to automation, we quantified this benefit earlier this year. We think it could be a $20 billion plus profit benefit to the company overall.
All right, Corey, we're going to have to leave it there. Thank you so much for joining us. That was Corey Charlo. He is Jefferies' Senior Vice President of Equity Research. Now, the hype around AI is fueling some of the gains that we are seeing in the venture capital ecosystem, accounting for more than 60% of the increase in total venture-backed valuations. That's according to data from PitchBook. Joining us now on this, we've got Kyle Stanford. He is PitchBook's lead VC analyst. Kyle, thanks so much for being here. So this data is fascinating. You have, for example, in here that there are 13 new AI unicorns over the past year. My question, are these unicorns real? Are the businesses there, or are they just slapping AI on the name and that's fueling valuations?
You know, I think there probably is some of that, right? If you look across the broad range of companies that are tagged as AI that are receiving funding, obviously there are some high outstanding companies that are able to command the large valuations and are likely going to grow into it. On the flip side, there's also, when there's a huge amount of interest in the market, there's going to be companies that are able to slap AI on their business model, say that they're using it or developing a new technology when they're actually not. We are starting to see some likely sloppy deals down at seed and Series A. The Series A valuation for AI companies is almost 30% higher than for the rest of the market. So there is probably some of that little, you're right, kind of sloppiness happening in VC, but all in all, when we look at AI is definitely where the interest is in VC, and it's building a lot of great companies.
Yeah, Kyle, I'm curious from the conversations you're having, the numbers that we have seen and the trend that we have seen towards AI, this interest that seems to be sweeping Wall Street. Is this a story that you think is going to stay with the markets here for quite some time?
Yeah, it is, right? I don't see any change in the interest in AI that VC has right now. Obviously, we've gone through cycles like this, and crypto has been a cycle. Fintech has been a cycle, and those have fallen off recently. But right now, what everyone's looking for is efficiency. They're looking for automation, and AI is what is building that. When you look at the public markets too, the companies that are really driving the market performance, Microsoft, OpenAI, or Microsoft, Amazon, NVIDIA, those companies are all focusing on AI and trying to drive that story of how their future growth is going to come through that technology.
I think that's the key thing that so many of the folks who come on our show talk about is, especially heading into this earnings cycle, which companies are going to be able to prove out their AI investments. What is the single biggest thing that you have seen in your role as a leading indicator that the companies that are AI plays are actually ones that are going to still be good AI plays 10 years from now?
Sure. I would definitely caution that one quarter is not going to be the telltale sign of which companies are able to prove out their AI play. But right, when you look at what Google has done and improve its growth story through AI, look at how Microsoft is trying to grab AI and make sure that it is part of every part of their product. I think AI is going to be the long-term growth story of the market.
I just want to ask you a random one, Kyle.
Sure.
I just watched this viral TikTok about how VC is the role to go into in finance if you want to make the most money and also have a moderately normal work-life balance. Do you think that's still true given some of the changes that we've seen in the VC space over the past couple of years for folks who may be interested in that as a career path?
Yeah, I think that TikTok story was definitely what was happening in 2020, 2021, right? This was the hot kind of sexy finance job to jump into, raise a fund, collect the fees, make some really, nice looking investments and be able to say that your portfolio holds all these, new unicorns. I think what we're showing now is the way the market has fallen out of VC is that this is a very tough game. There has to be a sourcing model. There has to be proprietary deal flow. There has to be a reason for LPs to come and invest in you. And it's no longer easy to raise a fund. Even for brand name funds or firms that have long track records of performance are actually trying to find a way to get DPI out. LPs are very cautious. And so jumping into VC sounds great, and it is still a great career path, but it's not going to be nearly as easy as it probably was a couple of years ago when TikToks like that were kind of coming up and made it seem like it was, the new hot thing.
All right, sage advice for all the TikTokers, including myself listening here. Kyle, thank you so much, as always, for joining us. That was Kyle Stanford. He is PitchBook's lead VC analyst. We're going to have all of your markets action ahead right here. You're watching Catalysts.
The S&P 500 is on track for its 38th record high close as earnings season gets underway. We got results from Delta, Pepsi, Conagra Brands this morning. All three stocks under a bit of pressure as we saw weakness in the consumer weigh on results. Now, investors are looking ahead to those big bank results and ultimately what exactly this is going to tell us about the economy, tell us about corporate America, the health of corporate America, and maybe whether or not this momentum to the upside, this unrelenting momentum to the upside, whether or not there is enough there in order to keep that movement, I guess more so that trajectory to the upside now between now and the remainder of the year. But I really think obviously, a lot of the focus, Maddie, is going to be on the growth, the earnings growth that we're seeing in those handful of stocks and tech stocks and communication services that have really been driving the narrative over the last couple of quarters. But I think we're going to see more and more focus on the earnings growth that's expected to show in the remainder of the S&P 500, and ultimately maybe what that trend then tells us about the fact that we are seeing this widening in terms of breadth, and maybe we shouldn't be as worried about the concentration that we do see today in the market.
Yeah, it's a great point about the broadening that we could be seeing, and you're looking at a chart right now where you can see that purple bar is the Magnificent Seven big tech names, and the blue bar is the rest of those 493 names. And I know you pulled this chart for us, Shauna, but it points to an interesting broadening that we're starting to see, and we even saw it on the heels of that cooler than expected CPI print this morning, with the Russell being the major standout index in terms of gains off of that print, potentially a view that some of these companies that are a little bit more rate sensitive could be potentially seeing some catalyst for growth on the heels of potential upcoming rate cuts. Having said that, the bar for earnings, it continues to be higher and higher. We're looking for expectations of at least 8% growth, and that is a hurdle that gets harder and harder to hit when you've had record-breaking growth the previous cycle, and we know that we've been having that. That's part of what's led us to so much incredible growth in the past year. I saw a stat this morning that in the past century, there have been two records for the market. One of them was this year in terms of growth, and the other was 2021. So if you've been in this market since 2020, you're very happy, but you're potentially getting a little tired of the AI rally and the tech trade. So investors are certainly looking for that broadening story here, Shauna.
Yeah, and to put some of these record closes in perspective, yesterday was the sixth straight day that the S&P closed at a record high, which now ranks as the longest streak since an 8-day streak, like we were just saying back in 2021. So again, just putting some numbers surrounding that. So we'll see whether or not this streak continues here. We do actually the S&P flipping into negative territory, although we're not too far from the flat line. Plenty of time to go here with just about, I don't know how many, 4 or 5 hours left in the trading day here today.
Yeah, it's interesting seeing the degree of those declines, especially in the NASDAQ here. But coming up, we're going to switch gears a little bit. We've got wealth that's dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned.
Welcome to Wealth. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, tools, tips, and tricks that you need to grow your money. Hey, on today's show, June's big CPI report. We'll talk to one wealth management expert about the best moves for your portfolio as inflation shows some signs of moderating. And inflation might be cooling, but consumers are still feeling some pain in their wallets, and it's about to get a little bit more painful for those Costco members out there. We'll tell you about the retailer's newest price hike. Plus, Delta is out with second quarter earnings, and the airline CEO says that summer travel demand is very healthy. We'll get some good travel tips and tricks to help you plan your vacation if you haven't already. Our top story, though, for you this morning, some good news for consumers. Inflation fell in June for the first time since 2020. Overall, prices actually fell from May to June by 0.1%. And by other metrics, consumer price increases are slowing annually. Headline inflation cooled slightly, and core CPI, which excludes volatile areas like food and energy prices, that cooled month over month and annually. So here are the three areas of the CPI print that we really want to highlight for you. The cost of food is still an issue. Food prices rising 2.2% on an annual basis, 0.2% from May to June, month over month. Both of those are increases from the prior month's report. Your grocery prices, or food at home, that also rose in June. All of this shadowing food and showing food that remains a sticky component of inflation. Now, our second highlight for you is the cost of your home or apartments here. Shelter costs rose 5.2% on an annual basis. That is, in fact, a slowdown from May, bolstering the idea that inflation is cooling, but the price growth is still high, a burden on many Americans. And our final highlight from the report is the price that you pay at the pump. Now, energy prices actually fell in June, driven by a significant drop in gas prices, which are down nearly 4% from May to June. Overall, the report is a positive sign for the Federal Reserve Chair Jerome Powell, who continues to say that the Fed needs more evidence that inflation is moderating. This is one of those pieces of evidence that they can look to. While headline inflation falling in June is fueling traders' hopes of a rate cut, nearly 90% are betting on one in September. That's up about 17% compared to before the print. To discuss how you can navigate inflation in your portfolio, let's bring in James Reagan, who is the D.A. Davidson Director of Wealth Management Research, here with us on the airwaves. Okay, let's dive into this. Where are some areas within the portfolio that are a little bit more exposed to inflation, and how investors can position themselves adequately?
Yeah, good morning. Good to be with you, Brad. Right off the top, I mean, we've seen with interest rates falling today, the bond market has rallied. So, just looking at bonds, that is something that I think investors are adding to portfolios today. We're seeing the bond prices rally, so that becomes something that investors should not forget about when they're building their portfolio allocations. Have an allocation to the fixed income markets. When we pivot over to the equity side, at least for today, we're seeing some of the more dividend sensitive, dividend paying sectors such as utilities and real estate investment trusts, the REITs, performing well. So we're seeing a little bit of a rotation out of the growth and maybe the technology or lower dividend payers into some of the sectors that pay higher dividends.
It's particularly interesting as we think about this dynamic that we've been watching play out, where equity investors are trying to kind of figure out where good news is or bad news is actually good news as it pertains to their equity portfolio. But at a certain point, doesn't bad news eventually have to become bad news? And what would you be looking for to really signal that the perhaps paradigm has shifted, if you will?
Yeah, I mean, it's a great point because, it's something that it can be a fine line, right? I mean, we've even seen it from Fed Chair Jerome Powell. I mean, yesterday at his testimony to the Senate Banking Committee, talking a lot more about the weakness in the labor market that they're seeing in the last couple of months, or at least in the most recent month, and that maybe that's something they're watching more closely than inflation right now. So as we're looking at this kind of soft landing scenario where economic growth slows, consumer spending slows, but stays positive, that's a pretty good environment, helps the inflation numbers, should allow companies to continue to report earnings growth. But if the consumer slows even more, and the economic growth slows even more, and we head more into a potential downturn, then that bad news does become bad news. So we're watching it closely. We're going to have to watch the labor market very closely, as Chair Powell has said, and we'll be watching a lot of the consumer data as it comes in over the summer.
It's interesting, as you were mentioning what we're expecting to hear from companies this earnings season as well. What do you believe the kind of prevailing theme or tenor around the macroeconomic read is that we could hear from some CEOs?
Yeah, I mean, the expectations for earnings are pretty good for the second quarter. Higher rate of growth, 8% or so versus the 6% that we saw in Q1. So we are expecting companies to put up pretty good numbers. I will say that it's a lot of the earnings growth is coming from some of the tech-driven growth-centric sectors. So I think they'll be kind of leading the way. So what we'd like to see is some of the companies below the radar that have, in sectors that have lagged this year, report good earnings as well. As we look at the second half of the year, expectations are that some of the technology earnings, the growth rates will slow. So we're going to need more broad participation in earnings growth across other sectors to kind of drive the overall earnings for the year. So as companies report, when we came out of the first quarter, a little less willing to give a full year forecast. But now with the year half over, we would expect companies to talk a lot more about what they see in the second half of the year. And I think companies it'd be more than just what the companies report. It's what the outlooks look for Q3 and Q4.
Yeah, really good point here. As we're thinking about what this first rate cut would mean to households and individuals, this morning we spoke to Mark Zandi, who's the Moody's Analytics chief economist, about how potential rate cuts might impact the consumers. I want to play here's what he had to say and get your reaction on the other side as well.
The most immediate benefit is to lower income households through lower payments on things like credit cards or consumer finance loans, buy now, pay later. Might see auto loan rates come in, and that would be very helpful for, again, lower middle income households who are unable to purchase a car because of the cost of financing.
So maybe it's not an all-out kind of come off the sidelines, purchase that new home if you see the first cut come in, but maybe it is a little bit of relief is what he was getting at there on some of the rates that people are paying right now. I'd love your read through.
Yeah, I mean, I would agree with that. Relief is a good way of putting it. I mean, when you think about it, a 25 basis point interest rate cut is not a game changer necessarily by itself. So it's what it says more about, is the Fed going to be able to continue to cut rates, and over time, if we look out into 2025, maybe we'll get several more of these cuts. So it does allow consumers some relief if interest rates on credit products come down a bit. So it's not necessarily going to make them feel good initially about spending more, but it does create some relief on some of the credit that they've already accumulated. I think over time we'll need more rate cuts to support more confidence in spending.
James Reagan, who is the D.A. Davidson Director of Wealth Management Research. James, great to speak with you here today. Thanks so much for the time and insights.
My pleasure, Brad.
With inflation slowing down, can we also expect our electric bills to go down this summer? According to the data, the answer to that, not so fast. Our own Rochelle Akufo has more on this. Great to see you, Rochelle.
Good to see you too, Brad. I wish I had better news for you. I mean, CPI data out today does show a seasonally adjusted monthly decline of 0.7% for electricity prices in June, and that's after being relatively flat in April and May. So why isn't that relief showing up in our electric bills? I mean, I know I had sticker shock when I got my bill this month. So keep in mind, on an unadjusted basis over the last year, electricity costs are up 4.4%. Now, if you're wondering why you're not seeing the same sort of relief you see at the pump, keep in mind that unlike gasoline prices, which are tied to underlying oil prices, which is a commodity, electricity is a service. So you have to factor in not just the bare price, you have the raw materials needed for power generation, you have labor costs, and you have the provider's capital projects that they're investing in, things like renewable energy plants. It's also highly regulated by state governments, so there is some pent-up pricing that's still making its way through. So don't expect your electric bill to go down so soon, even when inflation does continue to cool off. In terms of relief, you can call your utility company about some of their budget billing programs or even some payment assistance. You can also ask about spreading out the costs throughout the year versus being hit with that sticker shock during some of these peak seasons of heat and cold, because it is getting harder to gauge when these peaks are coming, especially as weather patterns are becoming more unpredictable, Brad.
So which states are bearing the brunt of higher electric bills this summer?
I mean, it's tough. As you look at this study that I found from the Texas electricity ratings, and they use data from the EIA, they found that Arizona residents will be hit the hardest. Arizona is shelling out an extra $100.15 on top of their average monthly bill. So they're looking at about $234 a month just in their electricity bills. Nevada is close behind with an extra $100.05 a month, with Texas, Oklahoma, and Georgia rounding out the top 5. So if you're looking for some relief, it's not coming anytime soon, unfortunately, but it is 7-Eleven today here in the US, so perhaps at least you can get a free Slurpee, cool off a little bit while you work out your financial plans there, Brad.
Yes, a slight bit of relief, interim relief here, indeed, at least for the day here. And yes, thanks for reminding us. It is 7-Eleven free Slurpee day. Yahoo Finance's own Rochelle Akufo. Rochelle, thanks so much.
You're welcome.
Well, I've got some bad news for all of you Costco lovers. The big box retailer is announcing a price hike. Now, before you freak out, they're not changing the price of their beloved $1.50 hot dog soda combo, but they are increasing the price that you'll pay for their annual membership. Effective September 1st, you will pay $65 for the year. That's about a $5 hike right there. Additionally, annual fees for executive memberships in the US and Canada will increase from $120 to $130, a $10 change. The exec fee consists of primary membership of $65 plus the executive upgrade of $65. And the maximum annual 2% reward associated with the executive membership will increase from $1,000 to $1,250. So overall, Costco says the fee increases will impact around 52 million memberships. That's a little over half of which being executive. So if you want to keep buying that Kirkland alcohol and toilet paper in bulk, you'll have to cough up the extra cash. We've got much more coming up on wealth on the other side of this short break. You're watching Yahoo Finance. 17,000 fewer Americans filed for unemployment claims last week, down to 222,000. That's according to the U.S. Labor Department. So what does this mean for everyday job seekers? Our very own Madison Mills joins me here in studio with more. Hey, Maddie.
Hey, Brad. So if you are a job seeker right now, this is not the best environment that we have seen over the course of the past 4 years following the pandemic. But I want to run through why we're seeing that in some of the numbers today. As you mentioned, claims falling by 17,000 to 222,000. Now, when fewer Americans file for unemployment benefits on a weekly basis, that is indicative of layoffs. So seeing this number falling means that layoffs are not happening as frequently. That's good if you're currently in a job. Where I'm seeing some toughness, and where economists rather are seeing some toughness, is if you are currently out of a job and you are looking. Now, this is showing up in the continuing claims data because that has risen recently, which is indicating that folks are having trouble finding new jobs. We also see the total number of Americans collecting unemployment benefits. That did go down a little bit, but it's still at 1.85 million. The 4-week average of claims also fell, but interesting to see that we're continuing to have that overall unemployment rate over 4%. That's the data that we got off of that critical jobs report. And just in terms of anecdotal data, we're getting this sense of just that tightness in your stomach right now from folks, especially people who have been looking for a job for a while. We're not seeing openings as frequently, and we get that data in something called the Job Opening Labor Turnover Survey, which of course you know about, Brad. But the openings piece has put a little bit of pressure on the labor market, particularly for workers who've been out of work and are still looking. But at least on the layoff side, we're seeing layoffs sticking to around 1%, which is a nice low number.
Yeah, that also impacts the wage improvements that some of those workers who are changing jobs are looking for as well. I mean, whether it be because you got a bad boss or because you just want to make a little bit more or get into an industry that you actually have a true aspiration to be in as well. A lot of those job switchers look for a strong labor market to be able to use that to say, okay, now I can perhaps make a little bit more in the next job that I step into here. Yeah. It's interesting as well within this headline figure that we're talking about of 222,000, that is still below this 4-week moving average here, sitting at about 233,500 right now for the past 4 weeks at this juncture.
Yeah, so another reminder that we aren't necessarily seeing these broader layoffs yet. One potential example that might be tough is we saw the layoffs coming from Intuit yesterday, the company citing AI as the reason behind some of those layoffs. And that is a challenge that's going to, I think, continue to be in the news for workers. But you bring up a great point on what we're talking about here, Brad, of the wage piece. And we, of course, know that that is the best way to increase your earnings is by switching jobs, not by getting a raise at the job you currently have. So if people aren't able to switch jobs, that could certainly be a headwind for our personal earnings.
Yeah, and where possible, employers, don't be stingy.
Right.
Just give them that increase. Anyway, Maddie, thanks so much.
Thank you.
It's been a busy week for Wall Street, and earnings season officially kicked off this morning. You got Delta Airlines plus PepsiCo financial reports. Big banks, they're set to take center stage tomorrow. And before you know it, we'll have those big tech firms reporting quarterly results. We saw the tech trade drive markets to new highs last quarter. Can it happen again in Q2? For an investor's guide into earnings, we've got Ken Mahoney, who's the Mahoney Asset Management CEO. I'm revved up, Ken. Are you? I mean, my goodness, what more could you ask for?
You guys be revved up, Brad. You got this going. Yeah, no doubt.
My goodness. All right. So, yeah, I was zeroed in on Delta this morning here and really kind of looking across the travel space. And we'll come back a little bit more to that in a second. But perhaps there were a few tea leaves that we could take from the earnings this morning in PepsiCo and Delta, more largely about the consumer. What should people be looking to hear about the state or the health of the consumer as earnings roll out this quarter?
Right. Just as you were just discussing, I think, it's like a frightened turtle. Right? Most consumers are afraid of not able to get that better job now, not be able to hop. They probably feel like they missed that window. Higher interest rates for longer, they keep on hearing about. They want to get a lower rate mortgage or be able to refinance. And it's all kind of feel like it's caving in on the consumer. And, for us, though, again, we invest more in the fast lane. We'll talk about that in a minute, technology. And we've been away from airlines and autos and, all these areas that are really more consumer focused. So it's not surprising to see Pepsi down a little bit today. But it is amazing when you think about Pepsi's brand, Quaker Oats and Lay's potato chips and Doritos. They're not just Pepsi Cola, so to speak. It's all these other brands underneath them. And it's shown it's not just how they reported for this, past quarter, which ended June 30th. It's really the forward guidance, Brad, that kind of it gave pause. And I think we're going to see that throughout earnings season. I think it's going to separate the tech from the non-tech, where the non-tech is probably not going to see any major earnings increases and so forth.
How much does this earnings season really come back to NVIDIA and how well this bellwether continues to impress the street?
So I think it's all been about earnings estimates. I get this all the time. How is it NASDAQ up 8 days in a row or 9 days in a row, setting records and hair scratcher when they read the headlines, the political cycle, the geopolitical cycle, all the problems they're seeing. It comes down to earnings. Analysts continue to, increase earnings. And after the first quarter of this year, March 31st, it was clear that earnings had to kind of catch up. And you had these analysts kind of falling over each other. I go from a buy to a strong buy. I go from neutral to a buy, 140 target to 170 targets. And that's what we've been seeing the last couple of weeks. It's because very soon, as you said, the big tech earnings are coming out. Tomorrow, the banks. But really, if you kind of look at it, it's really earnings estimates. And by the way, there's so much noise out there, the headlines. At the end of the day, stocks are really going to go and behave well with a good tailwind with earnings. And we're seeing that. Analysts keep trying to catch up, and they seemingly can't catch up to the earnings with technology because of all the capital spending that's happened.
What are the non-NVIDIA names that could make or break this earnings season?
Look, I always think, the big three now, we have Apple crossing 3.5 trillion valuation just a couple of days ago, first company ever to do that. Microsoft, NVIDIA now number 3. So I guess I look at the weighted averages, the weighted indexes. And that's, by the way, when people kind of talk about small cap and, international, no, we're still here because there's so much liquidity in those names because of, payroll tax, because of, money coming out of 401k plans, 403b plans, and a lot of money then finds its way to the weighted one. So, to your point, I think it has to be Microsoft, Apple, NVIDIA has to have good numbers to kind of keep this thing going. Amazon, Google, Donner, Blitzen, all those kind of big tech names that weigh heavily in the S&P 500 and very heavy into NASDAQ. We need to see those names be able to beat and raise guidance and then start that cycle again of analysts playing catch up.
I mean, look, it's only right that you're summoning Santa's reindeer into this conversation. We're looking for Christmas in July for a lot of investors out there, and that's when a lot of these big tech companies are certainly going to be reporting as well. Let's end with some actionable advice for investors out there. Of course, they're not trying to fight the Fed, but they are trying to anticipate the Fed. What words of wisdom would you bestow upon them?
I wouldn't overdo the Fed. I mean, a quarter point cut in September or November doesn't really mean anything to NVIDIA or Microsoft or Apple. I think you should get a shopping list together. You really can't buy here all in, last 9 days setting records. But you could put together and say, wait a second, I want to find those companies that are going to beat, estimates. They're going to raise guidance. And over time, you're going to see those analysts upgrade. So stay away from those companies that look tempting. In this earnings season, we're going to have Russian roulette. There's going to be some companies down 20%. Stay away from those. It's quicksand because most likely those companies missed estimates and they're guiding lower. So I guess, through your viewing audience, find those companies that they're going to beat and raise guidance, and you'll probably be rewarded. Definitely stay away from quicksand.
What is this, and I'll throw one bonus one at you. What does this earnings season mean for companies that are so detached from fundamentals that they've essentially ended up in this bucket of the meme trade?
There's been a lot of talk about Tesla. We kind of like the Magnificent Seven minus Tesla. Again, we just find Elon Musk very erratic. Love what he does, scientist, Doc in the Back to the Future type of guy. But this company's lowering prices. If you look in the video, they can raise prices, and Microsoft and some of these other companies, Costco this morning, raising their membership as you covered. But when you kind of look at Tesla, they've been lowering prices, and we don't like that. So that stock has gone up, 100 points in the last few weeks. I think ahead of fundamentals, considering they're lowering prices. So that to me is, again, I wouldn't go near a GameStop, AMC. That's been a long time talking about those type of things, Soaring Kitty and all that stuff. But right now, Tesla's starting to look like a mainstream type of meme, so to speak, because of this huge run it's had, maybe fueled by short covering initially. And maybe we're wrong. Maybe the sum of the parts are greater than the whole, and that's why it's trading like that. But I suspect it's a little bit more than that. So I'd be careful buying Tesla at these levels.
Yeah, Roaring Kitty. I'll just correct that for the transcript. No shade to you at all, Ken. I just want to get it right for the folks that are doing
what did I say?
Some SEO. Soaring Kitty. It was very close. Really only like two letters away on the QWERTY keyboard here. So.
Well, that's a big difference. Soaring versus roaring, I guess.
There you go. Ken, great to see you. Thanks so much
for
joining us. Absolutely. Ken Mahoney, who's the Mahoney Asset Management CEO. Appreciate it, Ken.
Right. Thank you, Brad.
Everyone, we've got much more wealth on the other side of the short break. You're watching Yahoo Finance. Delta Airlines reporting earnings, and even though a record amount of Americans are traveling, revenue from the economy class consumer was flat compared to a year earlier. Lower-end consumers might be feeling stretched despite today's inflation report showing fares dropping 5% month over month. To discuss how travelers are faring, we've got Laura Lindsay, Skyscanner global travel trends expert, here with us. And perhaps, Laura, and it's great to have you here on the program with us, perhaps it's some of the lower income cohorts that might be pushing back on prices that's also contributing to some of the declines that we're seeing, even in the CPI print, where we were kind of doing a Command F or a Control F, whatever type of operating system people are using, in order to look for airline fare declines in prices year over year. I want to know what you're making of the broader travel environment right now.
Course. So I would say that there's no doubt from segments that you were talking about earlier that people are facing a significant squeeze on their funds. And so they are really shopping around. We are seeing that if you compare prices, you can save money just by comparing different airline providers. And so airlines are needing to think carefully about their pricing in relation to that. But we're also seeing that consumers are taking on something that you might have seen called loud budgeting. So making sure that they are prioritizing certain spends over others. So perhaps foregoing some discretionary costs in favor of other costs like travel. So we are seeing people favor destinations that offer better value, as well as also thinking carefully about how they spend.
Yeah, that loud budgeting also means talking more among a lot of families, and even kind of interconnecting some of those conversations and planning with other, external family members to say, hey, just to let you know, we're going on this vacation, but we're going to kind of budget things out a little bit differently. Don't knock us for it. All that considered, when we're thinking about the destinations that people are going to, what are you seeing in the data from Skyscanner? What's popping right now and what's fading a little bit?
So the good news is that I can tell you some of the best value destinations. So we have seen price drops for really popular locations like Croatia. So Split and Dubrovnik both experiencing a 24% and a 22% price drop respectively for round trip flights from the US, which is great news for anybody thinking about European summer. But we're also seeing closer to home, somewhere like Nassau in the Bahamas is also experiencing a 23% price drop. So while previously we might have heard about prices increasing post-pandemic, as inventory has come back and travel is normalizing more, we are seeing price drops across many routes.
You know, it's particularly interesting, as I was speaking with the Delta CEO at Bastion, and we were talking about this recent quarter results here. It also comes back to where there's still strength in that more affluent consumer too, and where they're prioritizing spend. Where are you seeing even more of spending into the travel experience, where there are add-ons or even kind of just ancillary purchases that people are willing to make if it feels like it's beefing up their travel experience on the whole?
You're absolutely right that the experience is something that people are really investing in right now. So they are considering things like whether or not to upgrade their flight or whether or not to spend a little bit more money on accommodation, for example. We've seen a huge rise of something that we'd call Lux for Less, which is where people are looking for locations that they can get 5-star accommodation for prices that might be 3 or 4-star elsewhere. And we're seeing locations in Southeast Asia, for example, becoming increasingly popular, where you might be able to find those luxurious stays that are really giving you that break away from the everyday. So you're absolutely right in that regard.
And then just lastly, while we have you here, it was interesting to hear, and this is something that I think has come up at every kitchen table in one facet or another, or maybe the barbecue over the summer course, but everyone is thinking about, okay, who is flying certain aircraft? Where is the aircraft situation impacting which routes I'm going to be able to go to? And how are the airline operators really faring around this? And it was good to get some candid reaction from the Delta CEO around that, just talking about maintenance being more difficult and they're having to really be more considerate around the aircraft that they're keeping in fleet as they're taking on, I think, about 40 to 50 over the course of this year. What should travelers expect in terms of the routes that might be impacted, given the kind of overhaul of certain aircraft or maintenance, as well as a lot of operators are thinking about where their destinations are that they're prioritizing?
So I think during the pandemic, consumers understandably had increased concerns around operations. And actually, the US airlines got back up to normality much faster than other parts of the world. And there has still been some teething problems as we return to normal travel, but it has improved. We have seen a huge increase in mid-haul low cost, so those transatlantic budget airlines increasing fleets, which has improved prices for consumers and options for consumers. So I think the good news for consumers is that there are lots of options available. So it's really important that they look, particularly in the US, where many people think one airline first. It's definitely worth comparing the available options for the route that you're looking at, because there might be other options that you've overlooked previously.
Yeah, absolutely. Laura Lindsay, who is the Skyscanner Global Travel Trends expert. Laura, thanks so much for taking the time.
Thank you.
Well, it's summertime and more than 80% of Americans are planning to travel, according to a survey from The Vacationer. And according to NerdWallet, 1/5 of travelers plan to go into debt for vacations. But we want to help you avoid that and figure out how you can save a little money or earn rewards using travel credit cards. Here with how to pick the best card to deploy for yourself, we've got Yahoo Finance's Kendall Little. Hey, Kendall.
Hey, thanks, Brad.
Absolutely.
Yeah, so when you're looking for a credit card for your vacation, we like to think about it just like any other credit card. You know, make sure it fits your budget, it fits your spending habits. The first thing that you kind of want to look at is going to be that welcome offer, because you're going to be spending some extra money on airline tickets, on hotels, on all the things you're doing while you're traveling. You might be spending some extra money. You've probably saved up some. So this could be a great opportunity to get those hundreds of thousands of dollars in rewards value when you're getting that welcome offer. And then, of course, you're going to want to look at your rewards. So maybe you'll go all out and get a premium travel card, 5x or more points on airline and hotel rewards and rental cars. But you could also think about something like cash back, where you're saving money on the expenses that you're incurring while you're traveling, things like dining out, tourist attractions, even gas stations if you're driving. And then you also want to think about those extras. So something like no foreign transaction fees is a great benefit if you're traveling abroad. You can save anywhere from 1% to 3% on each transaction that you make internationally. And then things that can help protect you in case anything goes wrong. So busy travel season, we might see delays, we might see cancellations. Rental car insurance, baggage delay insurance, travel cancellation or interruption insurance is really going to help you against any of those things that could go wrong.
And my thanks to Kendall Little breaking all that down, especially during a busy summer travel season for some of those weddings too. Coming up, are you doing everything you can to be best set up for retirement? That is next. The IRS is ramping up its collection enforcement, announcing they have already collected over $1 billion in past due taxes from millionaires with over $250,000 in tax debt. Back in 2019, the audit enforcement for taxpayers earning more than $1 million in income was 0.7%, down from over 7% just 8 years prior. Now, due to billions of dollars of funding from the Inflation Reduction Act, the IRS identified approximately 1,600 taxpayers with more than $1 million in income and more than $250,000 in tax debt. In a call with reporters, Treasury Secretary Janet Yellen said efforts to increase tax fairness and bring in revenue from high-end taxpayers who have not paid what they owe are already paying off to the American people. And while the IRS is touting its collection of over $1 billion from these individuals, the effort is actually still ongoing. The Inflation Reduction Act, one of the Biden administration's signature pieces of legislation, initially allocated $80 billion to the IRS, though $20 billion has since been cut as part of debt ceiling negotiations. The IRS said that they are also going to be focusing on 100,000 high-wealth individuals who the agency believes has not paid or filed taxes in years. The agency also wants to increase the rate of audits of hedge funds, as well as cracking down on the use of corporate jets for personal travel. The IRS said in a public statement, the new initiative involves more than 25,000 people with more than $1 million in income and over 100,000 people with incomes between $400,000 and $1 million between tax years 2017 and 2021. Switching gears from money you are giving away to money you should be saving. This past month, average asset allocation for 401ks increased to 71.9%. It's the highest level since January of 2001. Where were you when? For more on this trend, as well as some tips to help make sure you're setting yourself up best for retirement, we welcome in Rob Austin, who is the Alight Solutions Head of Research. Great to have you here, Rob. And let's dive right into this here. As people are trying to figure out the best solutions to tap into their 401k or beef it up, what is the first step that many people might be missing here?
Yeah, I think the first thing you want to do is make sure you're saving enough to get that full company match. Company match will change based off of where you're employed, but what we show is the most common match is a dollar for dollar match on 6%. So if you are not saving at least 6%, you're leaving money on the table, and it's really, really hard to kind of find that 100% guaranteed immediate return anywhere else that you're investing. Our research shows that it's about 20% of people are not saving enough to get that full company match.
Certainly. And so after you've gotten that company match, where else can you start to add on to your savings?
Yeah, so I think the other part is let's make sure that that money is working for you. You want to invest it. That's the whole reason that you're putting money in for retirement is to see that money grow. But over time, we see very, very few people will actually look and make sure that they're rebalancing that portfolio. In fact, last year, we only saw about 20% of people make any sort of trade at all in their 401k. And when you think about what happened in 2023, when, say, equities were earning 15, 20, 25%, and bonds were only like at 5 or 10%, the portfolio you had at the beginning of the year is certainly not going to match the portfolio that you had at the end of the year. So do a retirement checkup. And if you can't find the time for that, or maybe it's not something that you want to do, there are certainly options, things like automatic rebalancing, where you can kind of click a button to say, put me back into a 60-40 split, or use something like a managed account, which actually has a professional do the investing for you.
Why have so few people, or relatively few people, I guess here, traded or rebalanced their accounts at this juncture?
Yeah, so I think it's a number of different factors, Brad. I mean, I think one factor is some people are just not professionals. This might be the only exposure they have to the stock market, and so don't really understand things like profit-taking mode or even the whole concept of rebalancing. And so as the market keeps going up and up and up, people are very content just to watch that account grow. What we know from more than 25 years of tracking this information for people is people are much more likely to take an action and make a trade when the market goes down. And unfortunately, that's really bad market timing because people end up locking in losses as opposed to taking it when it's higher. So I think some of it's just human nature, and I think some of it is just some inexperience that people have.
Is there one retirement strategy that people can put into action perhaps before the Fed cuts interest rates?
Yeah, I mean, I would say do a quick checkup and say, what is exactly the right investment portfolio for you? And if you don't feel comfortable enough doing that, look for other options that are in your 401k, something like what's called a target date fund, which is designed to be an all investment. Look for maybe like some online advice or online guidance or a managed account, something where you can get a professional to ask you the questions. Well, what's your risk tolerance? What else do you have? How much do you have saved maybe outside the plan? And be able to look at ways to really construct a very holistic portfolio for you.
Rob Austin, great speaking with you, and thanks so much for the insights here. Alight
Thanks so
Solutions
much, Brad.
Head of Research, Rob Austin. Appreciate it. Coming up, everyone, is your favorite summer cocktail more expensive than last year? You're not alone. We'll discuss what's driving these higher prices on wealth next. Inflation largely cooling in June, but medical care prices are rising, and that hurts our wallets. To discuss what this means for your medical bills, let's bring in Yahoo Finance's very own Anjali Kamlani here with us. Okay, what do we need to be wary of? What do we need to beware of as well in this process?
We have a bit of good news.
Okay, that's good.
Yeah, a little bit.
Let's take that.
Let's break it down. So, of course, we know that healthcare costs always on the rise, right? That's something that is the tail of the U.S. healthcare system. But what we have seen in recent years is a little bit of a decline on that. The pace of growth has slowed, and that is in part due to the changes in how we are interacting with our healthcare system. So we did see that decline through the pandemic, and then by 2021, it started to pick up again, but at a much slower rate than before. We saw healthcare largely outpace other sectors for quite some time, and now it is not one of the biggest growth. So what we did see is, for example, month over month, take a look at that. It is 0.2% growth month over month compared to 0.5 in May. And then you have 3.3% year over year growth compared to 3.1% in May. So you can see that sort of slowing down. Meanwhile, look at the different sectors. One of them is going to surprise you. So we've got hospital services at 0.1%. Physicians services at 0.1%, and then prescriptions unchanged. Now, I know that clashes with everything you know about the healthcare system and the conversation happening right now with the FTC looking to really whittle out and whittle down where the high prices of drug costs are coming from. We know that the U.S. pays more than other countries, but the system and the industry has been slowing down those increases. And so that's where this is coming from. It's quite interesting, even though we still pay some of those high prices. And so What we also know is that on the jobs report side, I know we've talked about this before, we see that climb in those numbers for the jobs, and it really does, like a bang-up job every time. That is coming to a head as well, because we know with the more that they have to hire, the more that they have to adjust salaries and increase offerings, we're starting to see that also come to a head, and we'll see those increases filter through to our wallet. So largely speaking, healthcare will still be a problem, as always, but maybe not as quite high a pace as we have been used to in past years.
Really good breakdown on the correlation there. Yahoo Finance's own Anjali Hamlani. Thanks, Anj. Well, we all love to have a meal and a few drinks out with friends, but high prices could cause some of your friends to second guess that weekend brunch. In the June inflation report, we saw the prices of food away from home rise 0.4% on a monthly basis, 4.1% year over year. And prices for alcoholic beverages rose 0.2% month over month, 1.8% year over year. So, how are restaurants dealing with higher prices, and how is it impacting customer decision making? Noah Track, who is the F&B Insights VP of Strategic Partnerships. Great to have you here with us. Okay.
Thank you for having me.
We got to break this down a little bit. I mean, because as we're sitting here looking across the consumer experience and where consumers are still going to dine out and perhaps add on a little drizzy on top of it, I guess, a little beverage, you know, where is that decision making starting to trend right now from what you're seeing?
Yeah, so largely consumers are still dining out. They're dining out less frequently, maybe less lunches. But when they do dine out, they seem to be spending more money. And so we're seeing that as a sort of continued trend coming out of the pandemic. When consumers were still looking for better quality products, that coming from purchasing better quality alcohol spirits in retail. And so that transition into restaurants, we see that trend as continuing to happen into the foreseeable future.
Okay, and so with that in mind, where is the biggest kind of pushback right now that we're seeing? I mean, we're in the summer season, so this is going to reshape the type of cocktails or spirits versus wines versus beers that people are purchasing here too.
Yeah, everybody seems to be pushing back on all segments, beer, wine, spirits. We've started to see, obviously, increases in prices. Prices now tend to trend anywhere from $15 to $18 in your larger metropolitan cities. Even in high fine dining, we're seeing those prices up at $25. So it definitely is rough out there for consumers when they go out and they're trying to partake and imbibe.
What do you think it's going to take for cocktail prices to come back down? I mean, $18. We're talking about almost $20 a drink here.
Yeah, it's tough out there for consumers. I think we're sort of at the higher end. The F&B Insights data shows that it's starting to slow a little bit. The espresso martini was one of sort of the higher items that we saw in terms of price increases, up 10% since 2023. But what we're seeing is maybe we're at the higher end of that spectrum now. We don't foresee incredibly high increases through the end of the year, maybe starting to stabilize just a bit.
So with that in mind, let's keep these top summer cocktails up on the screen here right now, because we were showing some of the growth there. And let's dive into some of the others that we're talking about here. Where are you seeing cocktails specifically, the most popular drinks of the summer, kind of getting significant, not just price hikes, but what is driving the costs? I mean, is it some of the ingredients that go into these drinks?
So typically what we see with restaurants, they always outpace inflation. So while that still played a major role, the overall cost of doing business for restaurateurs has significantly increased and continues to increase. The price of alcohol has increased due to higher production and shipping costs. And then obviously we have the pressure on the labor market. And so all these are contributing factors in causing these cocktails to increase in price.
Wow. All right. Noah Track, who is the F&B Insights VP of Strategic Partnerships, giving us the need-to-know items on which drinks might save you at least a couple bucks when you're out there getting brunch or getting dinner. Thanks so much, Noah.
Thanks for having me.
Certainly. Hey everyone, let's do a final check of the markets before we go. As we're taking a look at the Dow, the S&P 500 and the NASDAQ were mixed. However, the Dow is in positive territory. It's up by about 0.2%. The S&P 500, though, that's down by about 0.8%. And then you've got a move lower by about 1.8% from the NASDAQ composite. We're going to track that closely going into the rest of today's trading activity. That is it for wealth in this 11 a.m. hour. I'm Brad Smith. Thank you for watching. But you can stay tuned for where the market settles out, where it continues to move. Market domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. You do not want to miss it.